So hello friends, and today's video is exclusively made for those students who are pursuing CA, CMA, Inter and you are appearing for May or November 2021 examination. And today's agenda is to solve a revision test paper which is issued for May 2021 examination. Alright, so without wasting time, let's get into the matter. Starting with the first thing, we will solve all the MCQs in relation to this RTP. Thereafter, we will start solving the descriptive questions. So the first thing that we need to solve, MCQ. Alright, so there is a big paragraph given, as you can see in the screen. There is a big paragraph given and there are certain additional points for this paragraph as well. And based on this paragraph, you need to answer question number 1 to 5. That's what they asked. Alright, so the first 5 MCQ is based on paragraphs. So based on this paragraph, you need to answer this first 5 questions. You don't have to write steps for this. You need to only choose the right option from the alternatives given. So based on the above facts, choose the most appropriate answer to question number 1 to 5. So let's start reading the paragraph. So Mr. Sathak, aged 38 years, Mr. Sathak, aged 38 years, working in Nobida Private Limited as a senior manager finance. His yearly pay slip for the financial year 2021 is as follows. Alright, so earnings part is given and deduction part is also given. Earnings, there is basic pay, dearness allowance, HRA, transport allowance, personal allowance, education allowance for children education allowance for 2 children, then medical allowance, bonus and total earnings is given. And on the other side, it is employees contribution to Provident fund, then profession tax, income tax and net pay is also given. And there are certain additional information in relation to this particular paragraph. So starting with the first additional information, his employer also contributes equivalent amount of contribution towards Provident fund. Then, so it is in relation to Provident fund. So I'll put a tick mark on this particular Provident fund area. Then dearness allowance forms part of the retirement benefit. So it is in relation to DA. Then he has intimated to his company that he would opt for 115 BAC. What is 115 BAC, friends? 115 BAC is the new parallel slab rates which can be opted by individuals or HUF if they satisfy certain conditions. So students who have watched my lectures, you might be aware about those conditions which are mentioned under 115 BAC. So in this case, the employee is going to apply 115 BAC while computing his total income. That's what they're saying. Alright. And also they are saying he has not submitted any investment proof to the company. Alright. Then he has paid 55,212 towards medical premium for his parents by account paycheck. So it is in relation to payment of medical premium. That is in relation to 80D deduction. Then he purchased the house of 28 lakh and taken a loan of 21 lakh from HDFC. He is paying EMI of 22,835 and possession of the house received on 1st April 2020. He himself is occupying this house and the total principal and interest paid for the year is 55,037 and 2,18,983 respectively as per interest certificate received from the bank for financial year 2021. So the point is he has an own house. For purchasing that house, you have taken a loan and is also repaying that loan including interest as well as principal. Alright, so that portion is given in the question. So it is totally related to house property. But again, friends, you have to be very careful. In this point number 5, they are not mentioning the date of loan and all. So the complete details of the loan is actually not available. But again, with the limited number of details, let's solve this question. Again, there are few more details, that is, he has 3 children studying in Sandalwood International School and the following are the components of school fees paid for the academic session. So this child 1, child 2, child 3, there is tuition fees, admission fees, book, stationery and uniform, infrastructure fund, then commute cost, activity fee and total fees is also given. Also, he says he has invested 5,000 in HDFC ULIP, that is unit linked insurance plan, and taken an LIC policy for his wife for rupees 10,000. Alright, then he has invested 12,500 and 25,000 towards NPS, National Pension Scheme, Tier 1 account and Tier 2 account respectively. So it is in relation to again chapter 6A deduction. He also has donated 50,000 in PM Care Fund created for the relief from COVID-19 pandemic in India. So that point is in relation to 80G donations given. Alright. Then point number 10, he says he has invested 40,000 in a listed equity share of Shaktiman Power Solutions Limited on 1/3/2020 at 200 per share and sells 100 shares at 350 per share on 1/11/2020. So STT, that means security transaction tax, is paid both at the time of sale and at the time of purchase. So it is in relation to capital gain, especially section 111A short-term capital gain impact is there. So based on the above facts, choose the most appropriate answer to question number 1 to 5. So we have completely read the entire paragraph. Now it's our duty to solve question number 1 based on the above paragraph. Alright. So what is question number 1? What would be the amount of income chargeable to tax under the head salaries in hands of Mr. Sathak for assessment year 21-22? So they have given 4 alternatives. So out of those alternatives, you have to choose the correct taxable income from the head salaries. You are not supposed to compute the total income. You are only supposed to compute the total income taxable under the head salaries. Alright. So let's start solving this particular question, friends. So I'll do one thing. There is no steps required for this particular question, but for a better understanding, I'm writing steps. Alright. So computation of salary. So starting with the basic pay. And what is the basic pay given in this question, friends? The basic pay given in this question is 6,34,068 rupees. So 6,34,068. Now there is a DA. And what about the DA? How much is the DA? DA in this question is 1,26,814. So 1,26,814 is the DNS allowance. Now, what is the next one? HRA. So HRA, that means house rent allowance received is 3,17,040 rupees. But there are certain few things that you have to be very careful. Normally, if an assessee receives HRA, that means house rent allowance, he can claim an exemption under 1013A. But in this case, in this question, the assessee is not eligible to claim HRA exemption under 1013A. Why? Because of 2 reasons. Reason number 1, he have opted for 115 BAC. If assessee is opting for 115 BAC, that means the new parallel slab rate, which is mentioned under Income Tax Act 115 BAC. If he is opting for that, then assessee is not supposed to claim what? One of the conditions for opting 115 BAC itself is, if he is opting BAC, then he is not supposed to claim the benefit of 1013A. That is one of the conditions. And there is one more reason. One more reason is that he owns a self-occupied house property, right? For purchasing that house property, he took a loan. Hope you remember in point number 5. So he's staying in that home and he's not actually paying any rent, right? If the person or the employee is not actually paying any rent, then that employee cannot take the benefit of what? 1013A exemption, and the entire HRA will be taxable in his hands. Alright? And hence HRA, no 1013A exemption. You cannot claim 1013A exemption, and hence the entire 3,17,040 rupees will be taxable in his hands. Alright. So moving forward with the next item, that is transport allowance. That is 19,200. For transport allowance, there is no exemption in income tax. So transport allowance, and the amount is 19,200. Alright. Now what is the next item? Next item is personal allowance, that is 5,09,088. Personal allowance is fully taxable. I will write it as PA. So that is 5,09,088 is the personal allowance. Now let's move on to the next one, that is children education allowance. So friends, again in children education allowance, normally assessee can take an exemption under 1014 of Income Tax Act. Hope you remember. What is the exemption? It is rupees 100 per child per month up to 2 children. That's what is the exemption provided under 10 subsection 14. But in this scenario, assessee cannot claim the exemption under 1014. Why? Because in the question it clearly states that he would opt for 115 BAC. Again friends, if the assessee is opting for 115 BAC, then no exemption under 1014. You have to ignore the exemption under 1014 if you are opting for 115 BAC. And the point is very clear. What is the point? The entire children education allowance will be taxable. So children education allowance is fully taxable. Why? Because assessee is opting for 115 BAC. So that entire 12,000 will be taxable. Again, moving forward, friends, next is medical allowance. Medical allowance normally is fully taxable. So medical allowance, it is not a perquisite, it is the allowance given. So I will write MA, that is the medical allowance, and the amount is 15,000 rupees and it will be fully taxable. Now friends, what about the next one? That is bonus. Bonus fully taxable 20,000. So there is no doubt bonus, that entire 20,000 will be fully taxable. And what about the next one, friends? It is employees' contribution to Provident Fund. Do you have to consider that employees on contribution to Provident Fund as an income? It is not at all an income. Out of the salary you are receiving, you will contribute some amount to an employee Provident Fund. Yes or no? All right. And again, that 1,14,132 is not at all your income. You are applying it as a kind of your investment, right? Normally for that investment, you can claim an exemption under 80C, but here, point number 1, they are asking only the net income taxable under the head salaries. Alright, so you don't need to consider that 80C deduction from that particular point. Hope it is clear. And again, professional tax. Normally an assessee can claim that professional tax paid as a deduction under section 16, but one of the conditions for claiming 115 BAC is that assessee should ignore the exemption which is mentioned under section 16. So if you are opting for 115 BAC, that means the new parallel slab, you should ignore the exemptions under section or deductions under section 16. That's why you cannot claim any standard deduction, you cannot claim any professional tax paid as a deduction as well. Alright, so both the standard deduction and professional tax deduction gone if you are opting for 115 BAC. So you cannot claim that 2,400 as what? As an exemption. And income tax paid, again, income tax paid you cannot, in no case you cannot claim it as a deduction. And hence what you can do, I think we have done with these items. So 6,34,68 plus 126,814 plus 317,040 19,200 plus 5,09,088 plus 12,000 plus 15,000 plus 20,000, and there is one more item remaining. What is that, friends? His employer also contributes an equivalent amount of contribution towards Provident Fund. So when employer is contributing something to the Provident Fund, what the employee is indirectly getting a benefit. Yes or no? So you have to consider that benefit as a taxable salary. So we can write employer's contribution to Provident Fund. And here the question is not specific whether it is a statutory Provident Fund, a recognized Provident Fund or unrecognized Provident Fund. We don't know. Alright. So our assumption is that this is a recognized Provident Fund. Unless otherwise it says it is an unrecognized Provident Fund, you can always consider a positive assumption. So what we are taking? Our assumption is this is a recognized Provident Fund. And based on this assumption, we are going to solve this adjustment. Alright, friends. So if an amount is contributed to recognized Provident Fund, it says employer also contributes equivalent amount. So the contribution made by the employer would be definitely 1,14,132. So whatever employee contributes, the same amount will be contributed by the employer. That was the point test. Alright. So employer and employee both contributes 1,14,132. So the employer contribution is 1,14,132. Alright. Now the point is, from that employer's contribution, employee can take a deduction, an exemption. What is that exemption? Hope you remember. It is 12% of salary. Salary here means basic salary plus DA forms part of retirement benefit plus commission if it is expressed as fixed percentage of your turnover. So 12% of this salary, and salary definition is also stated there. It is basic salary plus DA forms part of retirement benefit plus commission if it is expressed as a fixed percentage of your turnover. And here all the information is available in the question. Basic salary is given in the question. And what is the basic salary, friends? Here basic salary is 6,34,068 rupees. And the question specifically, the paragraph specifically says that DA forms part of retirement benefit. Alright, so you can consider that entire DA, that is the DA amount is 126,814. So 1,26,814 is the DA amount into 12%. So the total amount's 12%, up to 12% you can claim a exemption. Alright, so 12% it would be 91,306. So that much amount is the exemption. So after deducting 91,306 from 1,14,132, the remaining amount will be 22,826, and that will be taxable as an employer contribution to a recognized provident fund. Hope this much is clear. Alright, and in the paragraph there is no more adjustment which is in relation to salary. So what we can do, we can compute the gross salary. The gross salary. So if we add all these items, our total would be 16,76,036 rupees. 16,76,036 would be our total. Now from a normal gross salary you can claim standard deduction as well as professional tax paid as well as entertainment allowance. Entertainment allowance is only applicable for government employees. Alright. And again friends, since assessee has opted for 115 BAC, he cannot claim any of these deductions which is mentioned under section 16. So you have to give up 3 of these. So no deductions under section 16. And finally you tell me what will be the net taxable salary. It would be 16,76,036 rupees itself. Now let's go to the options given in the question to find out whether there is an alternative which says this amount, that is 16,76,036 rupees. So the answer to question number 1 is option C. Alright, so question number 1 is solved and the option is option C is the right answer. Now let's move on to question number 2, friends. So question number 2, it says, based on the paragraph you have to solve question number 2, and it says whether the tax deducted at source by Nobita Private Limited on salary paid to Mr. Sarthak based on the intimation submitted by him is correct. So what you have to do, you have to choose between these options whether TDS amount is correct or not. So under 192, hope you remember TDS provisions, under section 192 of Income Tax Act, how to deduct TDS in the case of salary. In the case of salary, how to deduct TDS? The entire tax liability payable by the employee on his salary or on from other incomes, that entire amount have to be deducted as TDS. Alright, so first of all we need to compute the taxable income. For that there are a few information given in the question. So what all are the information, friends? I will point out that information. So please listen here. It's very clear that he has paid 55,000 towards, not that point, sorry. He has intimated to his company that he would opted for 115 BAC for assessment year 21-22. Consequently, he has not submitted any investment proof to the company. So, normally, when an employee is in receipt of salary and if he has some investments or if he has some other income information, he will submit a document to the employer. And what is that document? It says, I have invested in these funds, so I'm eligible for chapter 6A deduction, etc, etc, etc. But in this case, assessee has not submitted any proof to the company. That's what they are saying in additional point number 3. So what is the point? The only information available with the employer would be that salary given along with the allowances and other benefits. So employer, you have to think from the perspective of employer. For deducting TDS, employer should have a complete information on the investments and other expenditures or other incomes earned by the employee. But here, employee has not submitted any other investment proof to the company, and hence the only information available with the employer is that salary information. Hope you got my point. Alright, and we have already computed that taxable salary or income taxable under the salary if that employee is opting for 115 BAC. So that is 16,76,036 rupees is the net taxable income from the head salary if the employee is opting for 115 BAC. Yes or no? So what we can do, based on this, we need to compute the tax liability. So we have to think from the point of view of employer. And the employer has no additional information in relation to employee, and the only information is that salary. And now that total income from the perspective of employer. This is from the perspective of employer, all right. So total income from the perspective of employer would be 16,76,036 rupees, because employee haven't produced any investment details with the employer, all right. Now you can apply the slab rates. And friends, what is the slab rate and what is the tax rate as per section 115 BAC? I'll tell you, up to 2,50,000 you need not pay anything, 0% is the rate. Then from 2.5 lakhs to 5 lakhs the percentage is 5% and the tax liability would be 12,500. Then from 5 to 7.5 lakhs the liability would be 10%, that is 25,000 rupees. Now from 7.5 lakhs to 10 lakhs the rate would be 15% and that would be 37,500. From 10 to 12.50 lakh the rate is 20%, friends, and the amount would be 50,000 rupees. And from 12.50 lakhs to 15 lakhs the rate would be 25%, and friends, and the amount of tax liability would be 62,500. And above 15 lakh, how much income we have? Our total income from the perspective of employer would be 16,76,036 rupees, all right. So the amount over and above 15 lakh would be 1,76,036 rupees into 30%, and that would be 52,810. Now friends, what is the total basic salary? The total basic salary in this case is 2,40,310. That is the total basic salary. So 4% health and education cess will also come. Now friends, you tell me what is 4% health and education cess? It is 9,612 rupees, all right. So adding that also, what will be the tax liability? Tax liability for that assessee is if opting for 115 BAC from the perspective of employer would be 2,49,923. You can apply round of provision. If you apply, it will be 2,49,920 would be the annual tax liability of that employee. So annually the employer is supposed to deduct in total 2,49,920 rupees from the employee. That's what 192 is all about. All right. Now let's move on through that alternatives which is given in question number 2. And friends, which all are the alternatives as per question number 2? Alternative, it says, alternative number 1, it says what? Yes, the amount of 232,830 deducted as tax at source is correct. No, it is not correct, because our figure is not that, right? So again, what is the next alternative given? The next alternative given is no, the correct amount of TDS is 249,920, and that's what the answer we got. So the correct amount of tax to be deducted at source is 249,920. No, the correct answer of the correct amount of tax to be deducted at source is 249,920. And in the next option it says no, the correct amount of tax to be deducted is 242,800. No, the correct amount of tax to be deducted is 241,300. So the answer is option number B. I hope you got this point as well, friends. All right. So friends, the next is question number 3. So let's get into question number 3. It says, what would be the total income without rounding off of Mr. Ram for assessment year 21-22, assume that he does not opt for 115 BAC. Alright, so you need to compute that particular total income if he is not opting for 115 BAC. Alright, so let's get into more details, friends. So in the previous question we have assumed that this particular assessee has here the name given as Mr. Ram, but actually his name is Sarthak. So there is some technical error in the question. So you don't need to worry about the name actually. Alright, so the point is you need to compute the income of that person, assuming that he is opting for he is not opting for 115 BAC. That's what they are saying. Alright, so computation of total income is our agenda. So first we will compute the income under the head salary. So income under the head salary. Under income under the head salary, we need to compute the basic. The basic, we already know what is the basic pay which he is getting. 6,34,068 rupees is the basic which he got. And what is the DA he got? It is 1,26,814 is the DA. Alright, then there is house rent allowance. House rent allowance, he will not get the benefit of what? Section 1013A. Why? Because he stays in his own house. Hope you remember. So from this particular adjustment number 5 or point number 5, they have clearly stated that he purchased the house of 28 lakh and taken a loan of 21 lakh, and he is paying EMI, and the possession of the house is received on 1/4/2020, and he himself is occupying in this house. So assessee is actually not paying anything as rent, and hence he cannot take out the benefit of 1013A. The entire house rent allowance would be taxable in his hands. So what is the house rent allowance? It is 3,17,040 rupees. So 3,17,040 rupees would be fully taxable in his hands. And moving forward, the next is transport allowance, that is also fully taxable. Transport allowance, that is 19,200, it is also fully taxable. Then after transport allowance, is there anything? Yes, there is personal allowance of 5,09,088. So personal allowance 5,09,088 is also fully taxable. Then the next item is children education allowance. For children education allowance, in the previous question or previous MCQ which we have solved, he is opting for 115 BAC. That's why he was not able to claim the exemption under 1014. But in this alternative, our assumption is while computing the total income, this man is not planning to take 115 BAC. That means he can claim exemption under 1014. So children education allowance, and what is the actual amount he received? It is 12,000. So under section 1014, he can claim an exemption, that is rupees 100 per child into 2 children into 12 months. That is the exemption under 1014. Per child rupees 100 per month is the exemption. So it will be 2,400. So after deducting 2,400 from this 12,000, the remaining 9,600 only will be taxable children education allowance. So the medical allowance and bonus both are fully taxable. So I will write medical allowance, and the medical allowance amount is 15,000, and the bonus is, what is the bonus? It is 20,000 as well. Alright, now medical allowance and bonus is fully taxable. Now is there anything else in relation to salary? Yes. Employee contribution to PF, again it is not an income, but employer is also contributing an equivalent amount. That's given in the question. Alright, so employer contribution is there. So employer contribution, and we know what is the employer contribution taxable, because in the first MCQ we have solved it, right? So employer contribution, 12% of salary will be an exemption, and the remaining 22,826, and this would be the same if he is opting for 115 BAC or if he is opting for normal provision. The answer would be 22,826 itself. So I'm taking the same figure, we don't have to compute it again. Alright, so the employer taxable contribution amount will be 22,826, and there is employee contribution. And what is the benefit of employee contribution? Employee contribution can be taken as considered as a deduction under 80C. Alright, so chapter 6A deduction under section 80C, employee contribution to a recognized provident fund would be an eligible deduction. And what is that amount? And that amount would be 1,14,000. I'll write it here, RPF, and that amount would be 1,14,132. 132 would be the amount under 80C. That is employee contribution. Employer contribution, definitely a taxable income, and employee contribution is eligible to claim it as a deduction under 80C, because here we are computing the total income. That's why. Alright, now friends, professional tax paid, definitely you can claim that professional tax paid as a deduction, and definitely you can consider standard deduction as well. So I am taking standard deduction of 50,000 and professional tax paid also I'm claiming it as a deduction, that is 2,400, because in this alternative assessee is not taking out the benefit of what 115 BAC, so all these deductions are eligible. So first of all friends, let's compute the gross salary taxable. So for gross salary we will start from 6,34,000 plus 1,26,814 plus 3,17,40 rupees, then 19,200, then next is 5,09,088, then 9,600 plus 15,000 plus 20,000, that is bonus, plus 22,826, and the gross salary would be, what would be the gross salary? If you compute all of this, you will get the gross salary as 16,73,636 would be the gross salary. From that you can claim these two deductions. So from 16,73,636, if you claim is these two deduction, our net salary taxable or net taxable salary would be 16 lakh, I'll write it here, 16,21,236 would be the net taxable salary. Alright, now let's move forward friends. What is the next adjustment saying? So DNS allowance we have considered that. Then he intimated to his company that he would opt for 115 BAC. You don't have to consider this point number 3 here, because in question number 3 it is clearly states that he is opting for normal provision for computing his total income. That's what you are supposed to compute. And he paid 55,212 towards Mediclaim premium for his parent, and his parent is a senior citizen by account paycheck. So method of payment is given account paycheck, and the parent is a senior citizen. The question is actually silent whether the parent is a resident or non-resident. So if nothing is specified, then always assume that that person is a resident. So a Mediclaim premium has been paid for senior citizen as well as a parent. So for your parent who is a senior citizen as well as a resident by account paycheck. So what is the benefit? You can claim a deduction under 80D. And what is the amount of deduction? Up to 50,000 rupees you can claim it as a deduction. Yes or no? So what we can do under 80D up to 50,000. So parent medical premium paid. The actual amount paid is 55,212, but it is restricted to 50,000. Maximum 50,000 is the deduction which you can claim under 80D for this category. Then what is the next adjustment? The next adjustment, it says he purchased the house for 28 lakh and taken a loan of 21 lakh from HDFC. So HDFC is a financial institution. Then he is paying EMI of 22,835 and the possession of the house is received on 1/4/2020. He himself is occupying this house. Total principal and interest paid for the year is 55,037 and 2,18,983 respectively, as per interest certificate received from bank for financial year 2021. So the total interest and principal is given. So as you know, the principal portion you can claim it as a deduction under ATC. Principal portion you can claim a deduction under ATC, and what is that principal portion which he have actually paid? So under ATC, the principal portion he actually paid is 55,037 rupees. And what about the interest portion? Interest portion you can treat it as a deduction from house property head. So being a self-occupied property, the net annual value would be always 0. And interest under section 24B you can claim it as a deduction. And the actual interest in this question, it is 2,18,983. So 2,18,983 is the actual interest, but it shall be restricted to 2 lakh only. So 2 lakh is the maximum deduction, and the remaining loss from house property would be 2 lakh. So this is the loss from house property. Now you will ask me a question, sir, the actual interest is 2,18,983. So there is over and above 2 lakh, there is some interest he actually paid, right? So that 18,983, can we claim it as a deduction under 80 EEA? Alright, so we will discuss about that. So what about 80 EEA? Friends, please listen. In 80 EEA, there are certain conditions. Number 1, the stamp duty value of that house property should be less than 45 lakh. Number 2, the loan should be taken sanctioned between 1st April 2019 to 31st March 2021, and now it has been deferred to 22 as well. Alright, so there is a loan period. The loan should be sanctioned between 1st April 19 or 31st March 2022 as per the latest February 2021 annual budget. Now the question is, In this particular question, they are actually silent about in which date you have sanctioned that loan. The date of sanction of loan and all is not given. So it is open for you to take an assumption. You can consider the loan is sanctioned between 1st April 2019 and between 31st March 2022, or you can assume that the loan is taken before 1st April 2019. So what I am assuming, my assumption is the loan is taken before 1st April 2019. Alright, so by taking that assumption, I am solving this question. So my assumption is loan is before 1st April 19, and hence I am not claiming any exemption. Why? Because if you take this assumption only, you will get one of the alternatives which is given in that particular options. Alright, otherwise you will not get. So what you can do in examination, you have to stick on to one assumption and you need to compute the total income and check whether there is an alternative given in the MCQ set in the options. Alright, if there is not, go for the other alternative. That is the only way we can solve these kinds of questions. Alright, that's what the institute want you to do. Anyways, so here I am assuming it is not, it is before 1st April 2019, and thus he is not claiming any deduction under 80 EEA. That is only my assumption. We don't know the date of sanction of loan. Anyways, moving on to point number 5, he has 3 children studying in Sandalwood International School, and the following are the components of school fees paid for academic section 2021. So under 80C, up to 2 children, tuition fee you can claim it as a deduction. Up to 2 children, tuition fee up to 2 children you can claim it as a deduction. All other sum, admission fee, book, infrastructure, commute, activity, you cannot claim. So up to 2 children, the highest amount always I should consider. So 40,000 and 37,000 I should consider. So 80C, tuition fees, that is 40 plus 37, it would be 77,000 rupees. Alright, 77,000 rupees would be the tuition fee. So about 40,000 plus 37, it is 77,000. So that's over. Then he invested 50,000 in HDFC unit linked insurance plan. So HDFC unit linked insurance plan, investment in unit linked insurance plan is definitely an eligible deduction under 80C. So 5,000 I can claim it as a deduction under 80C. Again, there is an LIC policy taken for his wife. That means a family member, 4 rupees, 10,000 is the premium. So we don't know the date of issue of policy. We don't know the sum assured. Alright, there are certain conditions under 80C based on sum assured and the policy date. So now information is given in the question. So straight away I am taking this 10,000 as a deduction. Anyways, for life insurance policy, I can claim it as a deduction under 80C. But the total ceiling limit of deduction, we cannot arrive here. So I am taking that 10,000 as a 80C item. The entire 10,000 LIC premium, I am claiming it as a deduction, 10,000. Now, moving forward with the next adjustment, he has invested 12,500 and 25,000 towards NPS Tier 1 and Tier 2 account. So friends, in relation to NPS, National Pension Scheme, there are 2 kinds of investment, Tier 1 and Tier 2. Alright, if you are investing an amount to Tier 2 account, and you are a government employee, central government employee, you can claim that investment as a deduction under 80C. But in this question, Mr. S or R, whoever it is, he is a private company employee. So investment to Tier 2 account is not an eligible deduction under 80C. That is the first thing that you should know. So Tier 2, 25,000, you cannot claim it as a deduction under 80C. It is gone because it is only applicable for central government employees. Now what about Tier 1? Tier 1, definitely you can claim it as a deduction under 80CCD. Now the question is, friends, under 80CCD there are multiple options. Under section 80CCD, for employees contribution, you can claim deduction under 80CCD 1 or 80CCD 1B. There are 2 options. Alright, so under 80CCD subsection 1 is subjected to ceiling limit under 80CCE. Hope you remember 80C plus 80CCC plus 80CCD subsection 1 is subjected to 1,50,000. There is an overall ceiling limit. And there is one more way of claiming deduction, that is 80CCD subsection 1B. Without any ceiling limit, assessee can claim up to 50,000 as a deduction here. So always if there is an 80CCD deduction which is in relation to employees contribution, then what you can do? You can claim it as a deduction under 80CCD subsection 1B first. Whatever remaining can be claimed as a deduction under 80CCD1 because 80CCD1 is subjected to overall ceiling limit under 80CCE. That's what I've written here. So here I'm claiming this 12,500 as a deduction from 80CCD subsection 1B. So it is not subjected to any overall other ceiling limits. So that 12,500 I can claim. Alright, hope you got my point. Because why I'm straight away claiming from 80CCD 1B, because I have already some 80C deductions. So there is an overall ceiling limit as well. That's why I'm claiming it under 80CCD 1B first. Alright, now moving forward, he donated 50,000 in Pradhan Mantri Care Fund created for relief from COVID-19 pandemic in India. As you know, COVID is everywhere. So you need to be very careful, and that's not our point. Our point is, what should we do with this 50,000 PM Care Fund, donation? So what is the adjustment required? The adjustment is quite simple, friends. There are 4 categories of investment under 80G. Category 1, that is 100% deduction without ceiling limit. Category 2, 50% deduction without ceiling limit. Category 3, 100% deduction subjected to ceiling limit, that is 10% of your adjusted total income. Or category 4, that is 50% of your contribution subjected to ceiling limit, that is 10% of your adjusted total income. So this PM Care Fund is a new addition to category 1. So the entire 100% is allowable as a deduction under 80G. And again, that 50,000 you can claim it as a deduction, and the only condition is the method of payment should be other than cash. Here the method of payment is not mentioned. Again, to PM Care Fund and all, you cannot give a cash donation. That donation would be obviously through bank account. So 80G, that entire 50,000 I'm claiming it as a deduction. So is there anything else, friends? Now there is one more point. He has invested 40,000 in listed equity share of Shaktiman Power Solutions Limited on 1st March 2020 at 200 per share, and sells 100 per share at 350 and sells 100 share at 350 per share on 1/11/2020. So as you can see, the period of holding and STT is paid both at the time of sale and purchase. So if the STT is paid at the time of sale and purchase, then definitely it is a listed share. So the period of holding for determining whether a listed share is a long term or short term is 12 months. And here it is purchased in 1st March and sold in 1st November. So definitely it's a short term capital asset. If it is a short term capital asset and if it is a listed asset, then taxability will be under 111A. So we will compute the short term capital gain which is taxable under 111A. So let's move on. So capital gains under section 111A. That is, what is the full value consideration in this question? That is 350 rupees per share is the sales value. He sold 100 shares. So the total value would be 35,000 would be the full value consideration. Alright. Now the cost of acquisition, he purchased it for 200 rupees per share. That's what the question says. Into 100 shares are there. So 20,000 would be the cost of acquisition. If you deduct that 35,000 and if you can deduct the 20,000 from 35,000, the gain would be 15,000. So the short-term capital gain under section 111A would be 15,000 rupees. Alright. Now is there any adjustments remaining, friends? There is no other adjustment remaining based on the above facts. So now the question. Now let's compute everything together, friends. Now let's compute the gross total income first. Gross total income. So for computing gross total income, you need to consider the salary. This house property loss can be deducted from salary, and you need to add that 15,000 gain from that particular total income to that particular total income, and the total income would be 1621,236 minus 2 lakh plus 15,000, and the income would be 14,36,000. 236 would be the total income, gross total income. From that you can claim deductions. So chapter 6A deduction, first of all, 1,14,132 plus 55,037 plus 77,000 plus 5,000 plus 10,000. And what is the total? It would be 2,61,169. As you know, it is subjected to ceiling limit of 1,50,000. So you can claim maximum 1,50,000 as a deduction. That's it. You cannot claim more. So 1,50,000 is the maximum deduction that you can claim. ATD 50,000 is there. Then 80CCD subsection 1B you can claim 12,500, and again 80G another 50,000. So you tell me friends, what is the total income coming? Total income coming would be 11,73,736 is the total income. Now we will check whether there is an alternative which contains this answer. So moving on to question 3, let's check whether there is an alternative which contains such an answer. 11,73,736. Yes, option A is the right answer. If there is no alternative like this, then you need to take the other assumption. 80 EEA you can claim, and you have to check. But the point is, you should be very correct in solving the other adjustment. You should know the provision. Without knowing the provision, if you go for different permutation and combination, you will not get the answer. I know you know that. Anyways, let's move on to the next question. So friends, the next point is question number 4, or the next question is question number 4. What it says, what would be the tax liability of Mr. Sarthak for assessment year 21-22 if he does not opt for section 115 BAC? So in the previous question, we know the total income. Now we need to compute the tax liability. Easy task, right? So the total income is 11,73,736, and it consists of short-term capital gain under section 111A, that is 15,000, which is taxable at 15%. And friends, what would be the tax liability? 15,000, 15%, it would be 2,250 as the basic tax. Now what is the other income? If you deduct 15,000 from the total income, the other income would be, it is 11,58,736 would be the other income to the slab. And what is that slab? Up to 2,50,000, 0, 2.5 to 5, it is 5%, then 5 to 10, normal slab, right? 5 to 10, 20%, 10 above, 30%. If you can put this 11,58,736 into slab, then the basic tax would be, what is the basic tax? 1,60,121 would be the basic tax. So what is the total basic tax? Total basic tax is 2,250 and 1,60,121. It would be 1,62,372 is the total basic tax. So you can add 4% health and education cess as well, and the cess amount would be 6,495. 495 would be the cess amount, and totaling it, your basic tax plus cess would be 1,68,865, and you can apply the round off provision. If you apply round off provision, you have to round it off to the nearest multiple of 10, that is 870 would be the round off answer. So 168,870. Now we have to check whether there is an alternative which carries on that answer. So yes, alternative B, 1,68,870 is the right answer for question number 4. Now moving on to question number 5, friends. What it says, question number 5, it says, assuming for the purpose of answering this question only that no contribution is made by Mr. Sarthak and his employer towards Provident Fund, what would be the deduction available to Mr. Sarthak under chapter 6A? So if there is no contribution by the employer as well as employee, what will be the total chapter 6A deduction? That is the question. So what we can do, we can go to the previous answer, and under that chapter 6A area only we need to do. So in the question is very clear, he is not contributing anything to what? Provident Fund. Yes or no? If he is not contributing anything to the Provident Fund, then 1,14,132, that is not there. So only the remaining items are there. So let's compute what is the remaining item. So 55,037 plus 77,000 plus 5,000 plus 10,000. It would be 1,47,037 rupees, and that entire amount you can claim it as a deduction, 37. So there is no change in 80D, 80 EEA and 80 CCD and 80G. So friends, what would be the total chapter 6A? So total chapter 6A deduction would be, let's compute it together, 1,47,037 plus 50,000 plus 12,500 plus again 50,000, it would be 2,59,537, right? So 2,59,537. You don't need to round it off because it is chapter 6 deduction. Deductions, we don't round it off, alright. So let's check whether there is an answer. 2,59,537. Yes, that is option number B. So all the 5 questions which are in relation to that paragraph is completely solved. I hope you are very much clear about these 5 questions. Till now it is okay. Alright. So friends, the next thing is question number 6. It is actually an independent question, not as a part of that paragraph question. Alright. So Mr. Tejas, an Indian citizen, left India permanently with his wife and 2 children for extending his retail trade business of toys in Canada in the year 2015. So in the year 2015, Mr. Tejas, who was an Indian citizen, left India. Then from Canada, he is managing his retail business of toys in India. So for the purpose of his Indian business, he visits India every year from 1st September to 31st January. So his business income is 23.50 lakhs and 18 lakhs from retail trade business in Canada and in India. So his business income 23.50 lakhs from Canada and 18 lakhs from India respectively. That's what they are saying in the financial year 2021. Now, he has no other income during the previous year 2021. So he doesn't have any other income rather than this in the year 2020-21. Determine his residential status and income taxable in the hands for assessment year 21-22. So you need to determine his residential status and taxable income. So for determining residential status, the relevant previous year in the question is 2020-21. Alright, so this Mr. Tejas is an Indian citizen. Basically, he is an Indian citizen. So he left India. That's what they are saying. So every year he returns to India. Yes or no? Every year he returns to India. From which period? It says from 1st September to 31st January. That's what his visit is. So from 1st September we have 30 days. October 31, November 30, December 31 and January 31 days. Alright, so in total we can say 30 plus 31 plus 30 plus 31 plus 31. It is 153 days in total. Alright, so as you know, if a person is an Indian citizen, then how to determine his residential status, hope you remember. So for Indian citizen who resides outside India and comes on a visit to India, the normal, as per normal scenario or normal circumstance, there is only one condition. That is what? If his days of stay in India is 182 days or more, then he shall be a resident in that previous year. But as a part of February 2020 annual budget, a new insertion has been made, and as per the new insertion, the Act states that if a person being an Indian citizen resides outside India, comes on a visit to India, and his Indian sources income is more than 15 lakh, and his in the relevant previous year, if his days of stay is 120 days or more, and in 4 preceding previous year his aggregate days of stay is 365 days or more, then he shall be treated as a resident. Hope you remember that condition. So if his Indian sources income is more than 15 lakh in the relevant previous year, then in the relevant previous year, if his days of stay is 120 days or more, and in the preceding 4 previous years his aggregate days of stay in India is 365 days or more, then he shall be a resident in India. So let's check what exactly is his Indian sources income in this question. So as per this question, it's very clear. His Indian sources income is 18 lakh from India, right? So his Indian sources income is more than 15 lakh. It is actually 18 lakh in this particular question. So we have to check what is the number of days of stay in the relevant previous year, that is 2021. So in 2021, he is in India for 153 days. He is in India for 153 days. So the question also says one thing. He left India in 2015. Then from after that, every year he visits India from 1st September to 31st January. That's what they are saying. Alright. So from Canada, he is managing his retail business. For the purpose of his Indian business, he visits India every year. That's what they're saying. From 2016 onward, he visits India every year. So let's take the preceding 4 previous years. That means the relevant previous year 2021, that means preceding 4, 1920, 18-19, then 17-18 and 16-17 is the 4 preceding previous year. Every year 153, 153, 153 and 153. And total days of stay, 153 into 4, it will be 612 days. So his total days of stay in the 4 preceding previous years is more than 365. So all the conditions are satisfied. Then we can say he is a resident. He is a resident in India. Now we have to check he is a resident and ordinary resident or resident not ordinary resident. For determining whether a person is R or no R, there is a condition under section 6 subsection 6, and it says that if a person is Indian citizen or Indian origin and he resides outside India, comes on a visit to India during the relevant previous year, if his total income from Indian sources is more than 15 lakh, then his days of stay in the relevant previous year is 120 days or more, but it is less than 182 days. So in the relevant previous year, if a person's days of stay is 120 days or more, but it is less than 180 days, then he shall be always treated as an RNOR, and that's what the Act says under section 6 subsection 6. Again friends, let me repeat it. If you are an Indian citizen or an Indian origin and your Indian sources income is more than 15 lakh, and in the relevant previous year, if your days of stay in India is more than 120 days, but it is less than 182 days, then you shall be treated as what? An RNOR. And hence we can say in this question, Mr. Tejas is a resident but not ordinary resident. So he is a RNOR. So the first thing that we have to find out is his residential status, right? And his income taxable in the hands of in the year 2021-22. If he is an R or no R, then how to determine his taxable income in India? Then the only thing we have to check is whether an income is actually sourced in India. If there is source for a particular income in India, that's what we have to check. Source means two things, either accrual in India or first receipt is in India. Alright, but in this case, his 18 lakh is business in India. In this question it says 18 lakh is from Indian business. Alright, so 18 lakh, it very clearly states that it is actually from Indian business. And what about the other? And what about the remaining? It is actually the remaining 23.5 lakhs is from where? It is from pure Canadian business, right? It is a Canadian business, but he is managing his retail business of toys in India. From Canada, and he is managing his retail business of toys in India. So that's 23.50 is actually Canadian income. So India doesn't have any taxing right over that 23.50 lakhs. So his main business is in Canada. And from Canada, he visits India and managing his business in India. So his main base is not in India, main base in Canada. And hence that Canadian income 23.50 lakhs cannot be taxed in India. Only that 18 lakhs Indian income will be taxable in India because he is an RNOR for that particular previous year. And hence the final answer is he is a resident and not ordinary resident, and only 18 lakhs will be taxable in India. Now let's select the alternative. The first one, resident and ordinary resident, not non-resident, resident but not ordinary resident, and 80 lakhs from Indian retail business, retail trade business would be taxable in India. So the right option is option number C. I hope you got my point. Why option number C, friends? Again, I hope you understand the concept of residential status. But again, in relation to taxable income, if that income is from a business which is controlled or set up in India or managed from India, then that business income in Canada will be taxable in India. But in this case, the question is very clear. His main base of business is in Canada. For managing that business, he comes to India because he has a wing of business in India as well. So for managing that business that is in India, he visits India. That's very clear. Alright, and hence that 23.5 is not taxable in India. Only that 18 lakh will be taxable in India. So that is question number 6. I hope it is clear. Now friends, let's move on to the next question. That is question number 7. So it's again an independent question. Dr. Sargun has maintained 2 bank accounts. It's not Sugunan, it's Sargun. Alright. So Dr. Sargun maintained 2 bank accounts, one current account with Canara Bank for her profession, and savings bank account with State Bank of India. The following are the details of her withdrawals from these accounts during the previous year 2021. So there is a list of withdrawals given. So she furnished a return of income for assessment year 2021 and assessment year 1920 on or before the time limit prescribed under 139 subsection 1. However, for assessment year 18-19 and 17-18, she has furnished a return of income belatedly. Is any tax deductible at source under 194N on withdrawal made by Dr. Sargun from Canara Bank and SBI? If yes, at what rate and what amount? So you need to determine whether tax is deductible under 194N. If yes, what is the rate and what is the amount? That's what you need to determine. So friends, let's have a detailed look on this question. What is the relevant previous year? It is 2021. So the relevant previous year is 2021, and there is a condition. If an assessee hasn't filed his return in any of the preceding 3 previous years, then cash withdrawals in excess of 20 lakhs from a bank account will attract TDS under 194N. Hope you remember the new amendment. So let's check the preceding 3 previous years. That means previous year 1920, previous year 18-19 and previous year 17-18. These are the 3 preceding previous years. Alright, so as per the question, it's very clear that she furnished a return for AY 2021. That means PY 1920 she furnished. Then AY 1920. In 18-19 PY also she furnished. Then again for AY 18-19, that means previous year 17-18 also she furnished a return but belatedly. No problem. The point is she furnished the return in all. She furnished her return in all. Alright. So the point is, if she haven't furnished a return in any, here she furnished a return in all 3. So 194N will be applicable only if the cash withdrawal exceeds 1 crore. Alright, so 194N will be applicable only if the cash withdrawals exceeds 1 crore and the rate is at 2%. Alright friends, so let's have a detailed look from Canara Bank. What is the total withdrawal that she have made in the previous year 2021? So let's compute the total. From Canara Bank, the total cash withdrawal in the year 2020-21 is, let's compute it friends. So it is 25 lakhs plus 29 plus 14.20 plus 18.21 plus 26.23 plus 7.56. The total would be 1 crore 20 lakh 20,000 is the total. So if cash withdrawal from one bank exceeds 1 crore, then from that cash withdrawal alone you need to deduct tax. So here the Canara Bank is supposed to deduct tax on excess of 1 crore. Alright, so excess of 1 crore is 20 lakh 20,000 and the rate would be at 2%. And what is 2% on 20 lakh 20,000? It is 15 lakh, 1 second friends, let's compute it. So 20 lakh 20,000 into 2%, it would be 40,400. 40,400 would be the TDS amount. Now friends, what about the other one, SBI? State Bank of India. So let's have a look at the State Bank of India figures. 15.50 plus 14 plus 16.13. So from State Bank it is around 45.63, right? 15 lakh 50,000 plus 14 lakh plus 16 lakh 13,000. It would be 45 lakh 63,000 is the total withdrawal from SBI. 45 lakh 63,000 is the total with cash withdrawal from SBI, and 194N is not applicable. From one bank, if it exceeds 1 crore, then on that excess you need to deduct TDS at 2%. That's what 194N is all about. If from another bank, if the cash withdrawal is not exceeding 1 crore, you don't need to consider both withdrawals together. From one bank, if the withdrawal exceeds 1 crore, then TDS will be applicable on that excess amount of 1 crore. That's what 194N is all about. Alright. So friends, the answer to the question. Now let's move on to the options. So option number A, TDS is deductible at source on 33 lakh 79. No. TDS is deductible on 20 lakh 20 at 5%. No. TDS is deductible on 20 lakh 20 at 2% by Canara Bank, and no, TDS is deductible by SBI. So this is the right answer. C is the right answer because TDS is deductible at 2% over and above 1 crore, that is 20,20,000 by Canara Bank. Canara Bank is the deductor. And in the other case, SBI, no tax is required to be deducted by SBI. Why? What is the reason? Reason is quite simple, friends, because that cash withdrawal doesn't exceed 1 crore, and that is what is the answer to that question. All right. So let's move on to the next question, friends. That is question number 8. So friends, question number 8 is in relation to Miss Rimjim, age 32 years, an interior decorator, has professional receipts of 25,60,000 for the previous year 2021. She also earned 1,25,000 as dividend and 4,65,000 as interest income on fixed deposits. She incurred expenses of 13 lakh for her profession and 30,000 as an interest on loan for making investment in shares, on which she received dividend. What would be her total income for assessment year 21-22, assuming that she wishes to make maximum tax savings without getting her books of accounts audited? So interior decorator is of course a notified professional. So friends, tell me what is the impact. If she is a notified professional, then she can make use of the provision under section 44A(DA), that is presumptive taxation for notified professionals. And what is the advantage of that presumptive taxation? Whatever your gross receipts, 50% shall be the presumptive profit. All right. So we will take that professional income, professional receipts. And what is that professional receipts? It is 25,60,000 is her professional receipts. So under section 44A(DA), her presumptive profit, what is PP? PP means presumptive profit shall be, what is the presumptive profit? 50% on this 25,60,000, and that would be 12,80,000 would be her presumptive profit. Now, what about dividend income? Earlier, dividend income was exempted under 1034, but as a part of February 2020 annual budget, the central government has withdrawn dividend distribution tax, 1034 exemption, and 115 BBEA extra tax rate for shareholder. All of these three sections have been withdrawn. And now when a company declares dividend and when a shareholder receives that dividend will be taxable in the hands of shareholder under IFRS, under section 56. It is called the classical system of taxes. You receive income, you pay taxes for your income. That's it. So for that dividend income, assessee is supposed to pay taxes. And what is the dividend income in the question? She earned 1,25,000 as dividend income, and there is an expenses, and there is some expenses as well. So 1,25,000 rupees is the dividend income. 1,25,000 is her dividend income, and that is under section 56. So friends, there is one more income in this question, that is 4,65,000 as interest on fixed deposit. So interest income is also there. Interest on FD is also there. That is 4,65,000 is the interest on FD. Now friends, there are certain expenses. Number one, 13 lakh from her profession. There is an expense which is 13 lakh. That cannot be claimed. Why? Because we are opting for presumptive taxation. You cannot claim your actual expenses. So that expense 13 lakh is not deductible, because we have opted for 44ADA. 44ADA, we are presuming that our profit is this much. From that profit, we cannot again deduct any actual expenses. That is point number one. Then there is another expense, that is 30,000 rupees as interest on loan for making an investment in shares. So that 30,000 interest on loan, that simply means assessee has taken a loan. By making use of that loan, she purchased some shares of a company. From that share, she got some dividend. So that interest on loan is definitely deductible, but there is a ceiling limit. It's a new provision under section 57. And what is the ceiling limit? Maximum interest deduction shall be 20% of your dividend income. So it is actual interest is actually 30,000, but you cannot claim that entire 30,000 as a deduction. So 20% of your dividend income, that means 1,25,000 into 20%, that is the maximum ceiling limit. So 25,000 rupees you can claim as a deduction for this interest under 57. So I will repeat it again. If an assessee takes out a loan by paying an interest, and the loan amount is invested in some shares, And if that assessee receives some dividend from that shares, definitely assessee can claim a deduction for that interest paid on that loan. But there is a ceiling limit for that. And what is the ceiling limit, friends? It is 20% of the dividend income shall be the ceiling limit. That is the maximum amount of interest that an assessee can claim as a deduction under section 57. And hence what we can do, that 25,000 is the 20% on dividend income. So the income taxable as dividend will be 1 lakh. So friends, what is the gross total income in this question? 12,80,000 from your business income, then 1 lakh from your dividend income, and 4,65,000 from your interest on fixed deposit. So the total would be 18,45,000. Now the question you will definitely ask me, sir, can you claim 80 TTA? You cannot claim 80 TTA because only on savings bank interest you can make use of this 80 TTA deduction. Now there is one more doubt will come, sir, we can claim 80 TTB. 80 TTB is actually interest on deposits. It can be savings or it can be fixed, but it is only eligible for what? Senior citizens. So 80 TTA and 80 TTB both cannot be deducted. Why? Because as I see, the age is only 32 years and that interest income is from fixed deposit. Alright, and hence 18,45,000 will be the total income. Now what they are asking, 18,45,000 is the option number A, and that is the final answer to that particular question. I think it is clear. It's an easy question only. Alright, so without wasting time, friends, let's move on to the next question. That is question number 9. Mr. Arpan, age 35 years, submits the following particulars for the purpose of computing his total income. Alright, so income from salary computed, then loss from let out house property given, brought forward loss from let out house property 230, business loss given, bank interest given. Now compute the total income of Mr. Arpan for assessment year 21-22 and amount of loss that can be carried forward for the subsequent assessment year. So you are supposed to compute his total income as well as the loss to be carried forward to the subsequent assessment year. It's an easy question again. So let's compute it together, friends. It is in relation to Mr. Arpan, right? His salary income is given in the question, salary income, and that salary income is, they're saying it is computed. So you need not deduct anything more from that particular 4 lakh. It already says computed, right? Then loss from let out property 2 lakh. All right. So there is a loss from house property head. There is a let out property loss. Let out property loss. And what is that loss coming, friends? Loss from let out property, it is 2,20,000. That is the loss. And there is a brought forward loss from let out property for the assessment year 2021 also. So there is a brought forward loss from let out property. Let out property that is from the previous year. That means from assessment year 2021 is that loss. So that loss, and how much is that loss? It is 2,30,000 is that loss, right? So 2,30,000 anyways you cannot claim this year. Why? Because if you want to claim a brought forward loss from house property, then there should be income from the head house property. If there is no income from the head house property, then you have to straight away carry forward it to the next year. Alright, so this 230 you have to straight away carry forward. And out of this 2 lakh, there is no other house property loss or income. Alright, out of this 2 lakh 20, 2 lakh you can claim it as a deduction, because house property head, there is a limit for inter head set off for house property. Only up to 2 lakh you can set off from other head profit. Over and above 2 lakh shall be carried forward to the subsequent year. Hope you remember that inter head rule which is mentioned under section 71 of Income Tax Act 1961. So what you can do, up to 2 lakh you can set it off from, definitely from salary head. And the remaining 20,000, there is a 20,000 remaining that you have to carry forward to the next year. Again, format is actually not required because it is only an MCQ question. That's why I'm not preparing any format. But for a descriptive question, definitely I would give you a proper format. All right. Now, moving forward, friends, next is a business loss 1 lakh. And there is a bank interest received, that is 80,000. So there is a business loss and that is 1 lakh. And there is a bank FD, that is under IFOS, interest on bank FD. Interest on FD, that is 80,000 is there. So friends, there is a limit because after setting off this house property loss, what will be the remaining salary amount? The salary head amount remaining would be 2 lakh. Yes or no? Because we have done this set off. So can you claim this business loss from salary head profit? No. There is a problem between salary head and business loss, right? So business loss, you cannot set it off with salary head income. There is an inter head restriction under 71. So what you can do, you can set off this business loss from interest on FD, no doubt. You can set off that business loss from interest on FD, but interest on FD is only 80,000. And hence there will be remaining 20,000 have to be carry forward to the next year. Remaining 20,000 business loss have to be carried forward to the next year. So friends, what is the only remaining income which we have? 2 lakh will be the income which is taxable. That is, the total income would be 2 lakh. Now to carry forward, there is a business loss to carry forward, and that is business loss will be 20,000 that needs to be carried forward. Then loss from house property also required to be carried forward, that is 20,000 plus 2 lakh 30, that is 2 lakh 50,000 loss from house property to be carried forward. Loss from house property 2 lakh 50,000 to be carried forward. So let's see, is there an answer like that? So the answers, the options is total income 2 lakh, loss from house property 250, business loss 20,000. I think option number A is the right option to this particular question. So option number A, the first option is the right one. I hope it is also clear. And friends, to the final MCQ question. After this question number 10, all other are descriptive questions. So the final MCQ question. Mr. Vikas transferred 600 unlisted shares of XYZ Private Limited to ABC Private Limited on 15/12/2020 for 3,50,000 when the market price was 5,15,000. So the market price of the shares transferred is 5,15,000 and it is transferred for 3,50,000. That is the first thing. The indexed cost of acquisition of shares of Mr. Vikas is already given. Determine the income chargeable to tax in the hands of Mr. Vikas and ABC Private Limited in respect of the above transaction. So here, as far as the above transaction, you need to compute the income tax impact of these transactions. All right. So you have to compute the tax impact of both Mr. Vikas and ABC Limited. All right. So first we will compute from the perspective of Mr. Vikas. Mr. Vikas. So Mr. Vikas has transferred some shares, and these shares are clearly stating in the question these are unlisted shares. Yes or no? So these shares are unlisted shares. That's very clearly given. If there is a transfer of unlisted shares for a value which is less than fair market value, then the fair market value shall be deemed to be the full value consideration under section 50 CA. Hope you remember there is a provision called 50 CA in Income Tax Act 1961. It clearly states that what is the transfer value in this question, friends? It is 3,15,000. Yes or no? And what is the fair market value of that particular shares? It is also given. It's not 3,15,000. I think it is 3,50,000, right? It is 3,50,000. Yeah. It is not 3,15,000. It is 3,50,000. And what is the fair market value which is given in the question? The fair market value is 5,50,000. Fair market value is 5,50,000. So full value consideration shall be 5,15,000 under section 50 CA. Now, indexed cost of acquisition is already given in the question. And what is the indexed cost of acquisition? 4,25,000 is the indexed cost of acquisition. So tell me, friends, what is the capital gain here? It is long-term capital gain, not short-term. It will be long-term capital gain. For determining whether an unlisted share is long-term or short-term, the period of holding to be determined is 24 months. All right. And here, the shares are actually purchased, again, indexed cost of acquisition. They are saying indexed cost of acquisition, right? So definitely that would be a long-term capital gain. That's why indexed cost of acquisition is coming. So 5,15,000 minus 4,25,000, 90,000 would be the long-term capital gain taxable in the hands of Mr. Vikas. And what about the company, purchasing company? ABC Private Limited purchases these shares. They are purchasing shares having fair market value 5,15,000, but they are only spending their actual cost or their actual expenditure is 3,50,000. So under section 56 subsection 2 clause 10, if you are purchasing a movable property for less than fair market value, then what is the adjustment in income tax? Then you have to consider the difference between the fair market value and the actual consideration which you have paid. If it is excess 50,000, if it is more than 50,000, then that entire sum will be taxable in the hands of recipient under 56 subsection 2 clause 10. So here ABC Limited is only purchasing this shares for 3,50,000 and its fair market value is 5,15,000. So they are receiving a benefit, right? So that benefit 5,15,000 minus 3,50,000, it would be 1,65,000. It is the difference, and it is more than 50,000, and hence this entire sum will be taxable in the hands of ABC Private Limited under section 56 subsection 2 clause 10. Now let's move on to the answer which is given. 90,000 chargeable to tax in the hands of Mr. Vikas as long-term capital gain, and nothing is taxable in the hands of ABC. It is wrong. 75,000 chargeable, it is wrong. Then what about the next option? 90,000 chargeable to tax in the hands of Mr. Vikas as a long-term capital gain, and 1,65,000 is taxable in the hands in the head IFOs in the hands of ABC Private Limited, and option number C is the right answer. I hope this much is clear. So all the MCQ questions are totally over. Now we will start solving the descriptive questions. So question number 11, that's what we are gonna discuss next. So it is Mr. Dhruv, and as you know, it is a descriptive question. So Mr. Dhruv, a person of Indian origin and a citizen of country X, got married to Miss Deepa, an Indian citizen residing in country X, on 4th February 2020, and came to India for the first time on 2020. So on 2020, she made her first visit to India. So he left for the country X on 12th August 2020, and he returned to India again on 20 January 2021 with his wife to spend some time with his parents-in-law for 30 days, and thereafter returned to country X on 18/2/2021. Alright, now the question says he received the following gifts from his relatives and friends of her wife during 1st April 2020 to 31st March 2021, and the gifts are from parents of wife 1,01,000, from married sister of wife it is 11,000, from very close friends of his wife 2,82,000. Now you are supposed to determine his residential status and compute the total income chargeable to tax along with the amount of tax payable on such income for the assessment year 21-22. And they are also asking one more thing: will your answer change if he has received 16 lakh instead of 2,82,000 from a very close friend of his wife during the previous year 2021? And he stayed in India for 400 days during 4 years preceding the previous year 2021. So there is actually two questions, question number A and question number B. First of all, we will find the answer for question number A. That means determination of residential status and computation of total income along with the tax payable for assessment year 21-22. So friends, the relevant previous year for this particular question is 2020-21. So we have to determine the residential status of this particular individual for this particular previous year. So determination of residential status. RS means residential status. So friends, as per the question, it's very clear that he came to India for the first time. So that is the relevant paragraph which we have to focus. So Mr. Dhruv came to India for the first time on 20 February 2020, and he left for the country on 12th August 2020. Then he returned back to India again on 20th January 2021 to spend some time with his parents-in-law for 30 days, and thereafter returned to country X on 18/2/2021. That's what is the point. So determination of residential status of an individual is purely based on his days of stay in India. Yes or no? And there are two basic conditions for that. Condition number one, if his days of stay in India is 182 days or more, then definitely he will be treated as a resident. And there is also one alternative condition. What it says, if that person stays in India for 60 days or more in the relevant previous year and 365 days or more in the 4 preceding previous year, then also he will be treated as a resident. And as a part of February 2020 annual budget, there is a new insertion also. And what is that new insertion? If that person's Indian sources income is more than 15 lakh in the relevant previous year, and he stays in India for 120 days or more, and in the preceding 4 previous year, if his total days of stay in India, if it is 365 days or more, then again he will be treated as a resident. But there is one point for that: he should be a citizen or an Indian origin. These are the conditions which are applicable for determining the residential status. And now, by using this condition, let's compute the days of stay in India. So from 2nd February 2020 to 12th August is the first period of stay. So from 2nd Feb 2020 to which date, friends? It is 12th August 2020. So 12th August 2020. So as you know, the previous year starts from 1st April 2020 onwards. Alright, so 1st April 2020 means April, his days of stay in India would be 30 days. Then May, again 31, June 30, July 31, and August he stayed in India for 12 days. Alright, so 30 plus 31 plus 30 plus 31 plus 12. Let's compute it together, friends. 30 plus 31 plus 30 plus 31 plus 12. It would be 134 days. Total his days of stay is 134 days. So he stayed in India for 134 days. That's what the point is. Alright. Again, he again returned to India. That's what the question says. He again returned to India on 20th January 2021 for 30 days. Alright. So there is an additional 30 days which is from 20th January 2021 till 18th February 2021. So that days of stay is 30 days. So in total, his total period of stay in India for the relevant previous year, that means in 2021 PY, his total days of stay shall be 164 days. And this is his first time visit in India. Yes or no? It says for the first time he came to India for these periods. So friends, as you know, definitely it is less than 182. Alright. And 60 plus 365 is not also applicable. Why? Because he came to India for the first time on 20th February 2020. Yes or no? So if we take the preceding 4 previous years total, definitely it would be less than 365. Anyways, now we need to compute what exactly is this income which are taxable in India, or we can say the Indian sources income. So he got some gift from his wife, then from married sister of wife, then from very close friends of his wife. There are 3 gifts. Alright. So as you know, if you total everything of this, that means 1,01,000 plus 11,000 plus 282,000, in total it would be only 3,94,000. So even if you take this total receipt, it would be 3,94,000. So definitely we can say his total income from Indian sources is definitely way less than 15 lakh. Alright. So friends, our answer should be his days of stay. Days of stay less than 182. So that condition is not applicable. Then in the relevant previous year he stayed for 60 days, and in the preceding 4 previous year his total days of stay should be 365. That is also not applicable here. Alright. And again the point is why it is not applicable. Why it is not applicable? Because he came to India for the first time in his life on 2nd February 2020. Alright, so if you take that 4 previous year total, definitely it would be less than 365. So both the conditions are not satisfying. Alright, and hence we can say in the first instance his residential status would be what? Non-resident. If his residential status is non-resident, friends, then what you have to do? You have to compute the total income. That's what they are saying. Compute the residential status as well as you need to compute the total income chargeable to tax along with the amount of tax payable for assessment year 21-22. So computation of total income, that's what is the next agenda. So he is a non-resident, and computation of total income for previous year 2020-21. Alright, So let's compute the total income, friends. We will write a particular format, particulars, then analysis, and finally amount. So let's compute the total income first. So the first thing is he got some gift, all right, from relatives and friends. And first item is gift from parents, and the amount is 1,01,000. So friends, tell me whether this gift from parents 1,01,000 is taxable in India. The answer is under IFOS it is not taxable. Why it is not taxable? Why? Because if you got any gift from your relatives, then under section 56 subsection 2 clause 10 it is not taxable, because if the gift is received from a relative, and definitely parents of wife, that means your spouse and their parents are definitely included under the definition of relative. So parents of wife is definitely your relative, and that gift 1,01,000 is not taxable under 56 subsection 2 clause 10. So point number 1, gift from parents, not taxable, not taxable under section 56 subsection 2 clause 10, being a relative, and the taxable amount nil. Now let's move on to the second point, which is the second point, from married sister of wife. So both the brother and sister of your wife is also comes under the relative definition. Your wife, your wife's sister and brother and their spouse will definitely form part of a relative definition under 56 subsection 2 clause 10, and hence this 11,000 is also not taxable under 56 subsection 2 clause 10. So gift from married sister of wife, married sis of spouse or wife, again not taxable under section 56 subsection 2 clause 10, being a relative, and hence the amount is nil. And finally you got gifts from your very close friends. Definitely if you got a gift from your friends, it will be taxable under 56 subsection 2 clause 10 if the aggregate value of gift received in a particular financial year is more than 50,000. Here the amount of gift which you have received is 2,82,000, and hence it will be fully taxable. So gift from friends, gift from friends, fully taxable under section 56 subsection 2 clause 10, and the amount is 2,82,000. Alright, now these are the only incomes applicable for Mr. Dhruv in that particular financial year, and hence friends, what is the total income? So the total income would be 2,82,000 itself. Now let's compute the tax liability. If you opt for 115 BAC, that means the new parallel slab, or if you are opting for the conventional old slab rate under Finance Act, whatever be the slab rate, the tax will be the same, because for 2,50,000 to 5 lakh, in both the slabs, the rate is 5%. Alright, so irrespective of new slab rate, old slab rate, the tax will be the same. So basic tax computation first. Basic tax. Up to 2,50,000, you don't need to pay anything. It will be nil. Then 2,50,000 to 5 lakh, it is 2,82,000 minus 2,52,000. Then for the remaining 32,000, the rate would be 5%, and 5% of 32,000, it will be 1,600. Now the question is this person eligible for rebate under section 87A? Do you remember the condition for rebate? Rebate means if your total income is less than or equal to 5 lakh, then that assessee is eligible for a rebate, and the amount of rebate shall be either 12,500 or actual tax payable, whichever is less. Alright, so is the assessee eligible for rebate? The answer is no. Why? Because in this alternative, his residential status is non-resident. Rebate is only applicable for residents. Since he is a non-resident, he is not eligible for any rebate. So he won't get the benefit of rebate. And now the health and education cess at 4%. So 4% on 1,600, it would be 64 rupees. And the final tax liability including cess, it would be 1664. And you can round it off to nearest multiple of 10, that is 1660 is the final tax payable for alternative A. So we have determined the residential status, we have computed the total income, and also the final tax payable for alternate A. Now friends, it's time for us to go to alternate B. There is also a B part for this question. Will your answer change if he received 16 lakh instead of 2,82,000 from very close friends of his wife during the previous year 2021, and he stayed in India for 400 days during the 4 years preceding the previous year 2021? Will your answer change? Yes. And let's compute what exactly is the change. So in B part it says your gift from friends, if it is 16 lakh instead of 2,82,000, your answer change? And they are also saying one more thing. What they are saying, he stayed in India for 400 days during the 4 preceding financial year, preceding the 4 preceding financial year. That's what they are saying. So friends, I've told you, if you are an Indian citizen or a person of Indian origin and you have Indian sources income which is more than 15 lakh in the relevant previous year, and your days of stay in India, if it is more than 120 days in the relevant previous year, along with that days of stay in 4 preceding previous year, if it is more than or equal to 365 days, then you shall be treated as a resident. Yes or no? And in this alternative, his gift from friends is 16 lakh. So Indian sources income would be definitely more than 15. Alright, and let's see whether he is an Indian citizen or an Indian origin. That's what we have to check. Mr. Dhruv, a person of Indian origin. The question very clearly states that he is a person of Indian origin. Alright, so he is a person of Indian origin. So Dhruv is an Indian origin. And we know this is number of days of stay in the relevant PY. We have already computed, that is in the previous year 2021. He is in India for 164 days. So it is more than or equal to 120 days. So that condition is satisfied. Along with that, for preceding previous year, as per this question, his total number of days of stay in India is 400 days. That's what alternate B says about. So it is more than 365 days. So that condition is also satisfied. So definitely we can say Mr. Dhruv is a resident. Is a resident. Now the question is whether he is an ROR or RNOR. That's what we need to answer. Now hope you remember under section 6 subsection 6, for determining whether a person is RNOR, one of the condition is that if you are an Indian citizen or an Indian origin and your Indian sources income is more than 15 lakh and your relevant previous year's days of stay is 120 days or more, but it is less than 182 days, then you shall be treated as an RNOR. Hope you remember this condition. So what is that condition? I'll repeat it again, friends. If you are an Indian citizen or Indian origin, plus your Indian sources income is more than 15 lakh, plus your relevant previous year's days of stay in India is more than 120. It is more than or equal to 120, but it is less than 182. Then you shall be treated as a RNOR. This is one of the conditions under section 6 subsection 6 for determining whether a person is ROR or RNOR. So what we can say, definitely Mr. Dhruv here will be an RNOR. He is a resident but not ordinary resident. Now we will compute his tax liability and total income. So friends, again let's compute the total income. In case B, computation of total income of Mr. Dhruv, who is a RNOR. Here he is a resident and not ordinary resident. So for a resident and not ordinary resident, his Indian sources income will be definitely taxable in India. Alright, so instead of this 282, in alternate B, his receipt from friends is 16 lakh. That's what they told us, right? Again, gift from parents of wife, fully exempted. From married sister of wife is also not taxable in India. You know the reason why, because they are relatives. Alright, the only taxable income would be gift from relatives. Sorry, gift from friends. Alright, gift from friends would be the only taxable income, and it is 16 lakh. And that is the total income as well. So total income in that case is 16 lakh. Now let's compute his case by applying the slab rate. So friends, now we have to apply both of the slab rate. So after February 2020 annual budget, if you are computing the tax liability of an individual, then you have to apply both the old slab rates as well as the new slab rate. Then whichever is beneficial for the assessee, that one you should opt. So first of all, we will consider old slab rates. Old slab rates. Now what is the speciality of old slab rate? Up to 2,50,000, your tax liability would be 0%. Then from 2.5 lakhs to 5 lakhs, it will be 5%. That is 12,500. Then from 5 to 10 lakh, it would be 20%, and that would be 1 lakh here. And more than 10 lakh, here it is 6 lakhs. Into 30% would be the tax liability, that is 1,80,000. So 6 lakhs into 30, 1,80,000 would come. And what is the total basic tax, friends? So total basic tax would be 1,80,000 plus 1,12,500. It would be 2,92,000. 2,92,000 is the total basic tax. 92,500. All right. 2,92,500 is the total basic tax in this case. So this is basic tax, and health and education cess at 4% would come. So 292 into 4%, it would be 11,700, and including that, the final tax liability would be 3,04,200 would be the tax liability as per the old slab rates. Now friends, to the new slab rates. Under section 115 BAC, new slab rates. So 115 BAC new slab rates, here there are conditions. Definitely there will be only one taxable income, that is gift from friends. So that conditions have no other relevance. Alright. So as per the new slab rate, up to 2,50,000, the rate is 0%. Then from 2.5 to 5 lakh, the rate is at 5%, that is 12,500. Then 5 to 7.5, the rate is 10%, that would be 25,000 rupees. Then from 7.5 to 10 lakh, the rate is at 15%, that would be 37,500. Then from 10 to 12.5 lakhs, rate at 20%, and that would be 50,000 rupees. Then from 12.5 lakhs to 15 lakh, the rate is at 25%, that would be 62,500. Then above 15 lakh, that is 1 lakh in this case, into 30%, that would be 30,000 rupees. So what is the total basic tax coming, friends? The total basic tax would be, let's compute it together. It is 2,17,500, right? 2,17,500 would be the total basic tax. And what is the cess? At 4% would be applicable, that is 8,700 rupees. Now basic tax plus cess, health and education cess, it would be 2,26,200 would be the total amount. Now friends, if you are opting for the old slab rate, the rate would be 3,04,200. And if you are opting for 115 BAC, the new slab rates, it would be 2,26,200. So your answer should be, assessee will definitely opt for 115 BAC rate of taxes, and the tax liability would be 2,26,200. And this is the final answer to part B. I hope it is clear. It's actually a very good question. So friends, question number 12, that is our next target. So Mr. Rocks, a citizen of country Y, is a resident but not ordinary resident in India. So his residential status is straight away given. He is a RNOR in India during the financial year 2021. He owns 2 house properties in country Y, and one is used as his residence and another house property is rented for a monthly rent of 18,000. So he has 2 house properties in country Y. Alright, and one of them is used as his residence, and another property is rented for a monthly rent of 18,000. The fair rent of the property is $20,000, and the value of one country CYD, that means country CYD, it is their currency, maybe taken as 78 rupees. So it is the currency conversion rate is also given in the question. Now, he took ownership and possession of a flat in Delhi. So he took ownership and possession of a flat in Delhi on 1/10/2020, which is used for his self-occupation while he is in India. So the flat was used by him for 3 months at the time when he visited India during the previous year 2021. The municipal valuation of that particular flat is 4,58,000 per annum, and the fair rent is also given 3,60,000 per annum. He paid a property tax of 13,800 and 2,800 as sewerage taxes to Municipal Corporation of Delhi. So he had taken a loan of 18 lakh at 9.5% from HDFC Bank on 1st August 2018 for purchasing this flat. No amount is repaid by him till 31st March 2021. So it is a very good citizen, is not repaying his loans. Alright, very good character. Anyways, he also had a house property in Bangalore which is let out on a monthly rent of 40,000. So he has another house property in Bangalore which is let out for a monthly rent of 40,000. The fair rent of which is 4,58,000 and the municipal value is 3,58,000 per annum, and the standard rent is also given 4,20,000 per annum. He had taken a loan of 25 lakhs at 10% from one of his friends residing in country Y for this house, and municipal tax of 5,400 is paid by him in respect of his house during the previous year 2021. Compute the income chargeable from house property of Mr. Rokes for assessment year 21-22. So you need to compute the income taxable under the head house property. That's what the agenda is. Alright, so friends, let's move on to the computation of total income from house property, or computation of income from house property in the case of Mr. Rokes. So computation of house property of Mr. R for 2020-21 previous year. That's what we are going to do. And what is his residential status, friends? He is a resident but not ordinary resident. So his residential status is RNOR. For an RNOR, an income will be taxable in India only if it is accrued in India. Accrued in India. Or it is first received in India. Or it is first received in India. And there is one more possibility: if an income is accrued or arised outside India on account of business or profession which is set up in India, or managed from India, then also it will be taxable in India. That's what the Act says. So this particular column is the combined interpretation of section 5 and section 9. So for an RNOR, his income will be taxable only in India if it is accrued in India, or if it is first received in India, or it is a business or professional income which is accrued outside India on account of a business or a profession which is set up in India or managed or controlled in India. Yes or no? Now let's compute the house property income. First of all, we will consider the house properties which is in country Y, because he has some house properties which is in country Y. So friends, please listen. He has two house properties in country Y. One self-occupied and the other one is actually rented out. Now the question is, do we have to consider those house properties in country Y for the purpose of computing his total income in India? The answer is no. Why? Because the property is situated outside India. So the income is definitely accrued outside India, and it is from house property, not from business. And again, there is one more point: the rental income is also received outside India. So for these two properties which is outside India in country Y, India has no taxing right over that particular two properties which is in country Y. So first of all, we will start with a note, that is house properties in country Y, income not taxable in India. and we can take it as nil. For house property 1, which is self-occupied, and house property 2, which is actually let out, you don't have to consider any income or any expenses in relation to that particular property in India. Why? Because India doesn't have any taxing right over that particular property. I hope you got my point. Alright, now moving forward, now he has a property in Delhi, which is a self-occupied property. So we will write self-occupied property in Delhi. This is the first point. And second point, self-occupied house property in Delhi. So for self-occupied house property, we always take what? We always take the net annual value as what? As 0. We always consider the net annual value as what? 0. Alright, so the net annual value is 0. The only thing which we can claim is the deduction for interest paid. So it is actually used for self-occupation, friends. Then it says that he flat used by him for 3 months at the time he visited in India during the previous year 2021. That municipal valuation of that house is given, fair rent is also given. We don't have to consider that to municipal value and fair rent, because the net annual value for a self-occupied property will be always 0, and hence we don't need to compare the municipal value, fair rent, standard rent, etc., etc. All right, so he paid a property tax of 13,800 and 2,800 as sewerage tax to Municipal Corporation of India. Again, municipal taxes and property taxes, no deduction. Alright, if it is a self-occupied property, you cannot take that municipal taxes and sewerage taxes as a deduction. It is not possible. And again, he had taken a loan of 18 lakh and the interest is 9.5% on August 2018. And he took the ownership of the property on 1st October 2020. So there is a pre-construction or a pre-acquisition period is there. Alright, so let's compute the interest for pre-acquisition period. So interest on loan under section 24B, that's what we are gonna compute. So pre-acquisition period. And what is the pre-acquisition period? It is from, because how to compute, how to take the pre-acquisition period, friends? So we will do one thing, we will write a separate working note for that. Working note number 1. So he took the possession of the property. He took the possession of the property on which date? The date is very clearly stated here. It is 1st October 2020. Alright. So 1st October 2020. So in the year 2020-21, he occupied that particular property. So the pre-acquisition period is said to be from the date on which you have taken loan, that is from 1st August 2018, from 1st August 2018 till 31st March 2020, because normally we consider 2021 as year of completion or year of acquisition. Pre-acquisition period ends with the 31st March of the preceding financial year. That's what the Act says. So the relevant previous year where you acquired that property is 2021. So the pre-acquisition period ends with the 31st March 2020. That means the immediately preceding financial year of completion. That's what the pre-acquisition period is. So from 1st August 18 to 31st March 2019. What is the interest? And the loan taken is 18 lakh, right? So the loan taken is 18 lakh into annual interest is 9.5%. But here he haven't taken that loan for 12 months. So 12 months into how many months? August, September, October, November, December, January, February, March. And it is only for 8 months. So what is the proportion of interest? 18 lakh into 9.5% is the rate of interest for that particular loan. Divided by 12 into 8 months, it would be 1,14,000 is the proportion of interest. And again for 1st April 19 to 31st March 2020, full year interest is there because he haven't repaid anything back. Into 9.5%, full interest will come. So 18 lakh into 9.5%, it would be 1,71,000 as well. So what is the total pre-acquisition interest? Pre-acquisition interest shall be 171 plus 1,71,000 plus 1,14,000. right? And it would be 2,85,000. 2,85,000 will be the total pre-acquisition interest. So 2,85,000 is the total pre. Now how will you claim deduction for this pre-acquisition interest? Pre-acquisition interest is normally claimed as a deduction in 5 equal annual installments from the year of completion onwards or year of acquisition onwards. So in 2021, you can claim 1/5 of this 285, that is 57,000 rupees as pre, 1/5 of that pre portion. And in 2020-21, you can also claim current year's interest. Current year's interest for the full year, that is 1,71,000, can be claimed as a deduction in 2021 as well, because current year you have accrued an interest, right? You have to pay it, but you haven't paid anything. So definitely that is also claimable. So what is the total interest in 2020-21 as a deduction? 57,000 plus 1,71,000, and it would be 2,28,000. This is the actual interest. Now friends, being a self-occupied property, can you claim this entire 2,28,000 as a deduction? The answer is no. You cannot claim that entire 2,28,000 as a deduction. So the deduction is restricted to 2 lakh. Even though the interest pre-acquisition and current year interest total we will take 2,28,000 is the total amount, but it is restricted to 2 lakh. 2 lakh is the maximum amount of a deduction that we can claim for a self-occupied property. So claiming 2 lakh, loss from self-occupied property would be 2 lakh. This is the loss from the self-occupied property. All right. So again, there is one more property which is in Bangalore, right? So let's compute the information in relation to that particular property. So there is one more property in Bangalore which is let out for a monthly rent of 40,000. All right, and the fair rent is also given. So we will compute the gross annual value first. So house property in Bangalore which is let out. So first we will determine the gross annual value. For that we have to compare fair rent. What is the fair rent given in the question? So fair rent in the question, it says 4,58,000 is the annual fair rent. We need to compare it with municipal value. Now friends, what is the municipal value? 3,58,000. Normally we take whichever is higher. So the higher amount is 4,58,000. Now we will compare it with the standard rent. And what is the standard rent, friends? Standard rent in the question is 4,20,000. Now we will compare this and we will take the lower figure, and 4,20,000 would be the expected rent. 4,20,000 is the expected rent, ER. Now we will compare this expected rent with actual rent. And what is the actual rent? In the question it says 40,000 per month. All right, and the question is not specifying whether it is vacant or it is being let out in the part of year. It is no information like that. So we are assuming that it has been let out for the entire year. So 40,000 into 12 months, and that would be 40,000 into 12 months, it would be 4,80,000. So normally whichever is higher will be taken as the gross annual value. So the higher figure is 4,80,000. So gross annual value would be 4,80,000. From that you can claim what? Municipal taxes paid as a deduction. Only municipal taxes paid as a deduction you can claim. Now the question, are they talking about any municipal tax? Yes, 5,400 is paid by him in respect of his house during the previous year 2021. So there is a municipal tax of 5,400 in the question. So what is the net annual value of this after this municipal tax? Minus 5,400, it would be 4,74,000 rupees, 74,600. 4,74,600 is the net annual value. So on this net annual value we can compute standard deduction. Standard deduction at 30%. So into 30%, it would be 1,42,300 is the standard deduction. And again, deduction under 24B for interest on loan. There is an interest on loan for this property also. So let's compute the interest on loan for this particular property. Again, working note number 2, interest on loan for this particular property. And what is the loan amount? It is 25 lakhs. And the rate of interest is 10%, and we don't know the date of loan because the date of loan is actually silent in the question. So what we can do, we can take that entire 25 lakhs into 10% as interest, because the rate of loan is not mentioning clearly. So 25 lakh is the total loan into 10%, and the yearly interest would be 2,50,000. So for a let out property, there is no ceiling limit for interest and all. You can claim that entire 2,50,000 as a deduction. All right. So what I'm doing under 24B, 2,50,000 we can claim it as a deduction. So after claiming these two, what will be the income from that particular house property? 4,74,600 minus 142,300 minus 2,50,000. It would be 82,300 would be the income from house property. Income from house property. All right. Now let's compute it together. Now the net income or loss from house property would be 2,82,000 minus 2 lakh, because there is a loss of 2 lakh. Earlier we have computed a loss of 2 lakh, and we can set it off, and the remaining loss would be, the remaining loss from house property would be definitely loss. 1,17,700 is the loss from the head house property, and that is the final answer to this particular question. All right, 1 second friends, 1 second. Actually it is not 300, it is 380, right? So 4,74,600 into 30%, it would be, there is a small correction, 380 it is. All right, standard deduction is 142, 380 it is coming. So here also the figure will change. 4,74,600 minus 142, 380 minus 2,50,000, it would be 82,220. It would be the income. And here also the final answer will change. Minus 2 lakh, it would be 1,17,780 would be the loss. There is a small calculation error here. I hope you got the point. So 1,17,780 is the net loss from house property for the question number 12. All right. So friends, now it is question number 13. So question number 13, it says Mr. Prakash furnishes the following information for the financial year 2021. That means particulars and amount is also given here. Then loss from speculation business is given. It is actually a loss. Then profits from speculation business is given. Interest on borrowings in respect of self-occupied property. Then income from let out property is given. Presumptive income from trading and manufacturing business under section 44 AD is also given. Salary given. Interest on public provident fund deposit given. Long-term capital gain on sale of vacant land is given. Short-term capital loss on jewelry, so it is a loss. Again, investment in tax savers deposit 60,000. Brought forward loss of business of assessment year 15-16. All right, assessment year 15-16 means previous year 14-15 is also given in the question. Then donation to charitable trust recognized under section 12AA and approved under 80G, payment made via credit card is also given 60,000. And you are supposed to compute the total income of Mr. Prakash for assessment year 21-22. Also show the loss eligible to be carried forward. Assume that he does not opt for section 115 BAC. So the question is very simple. You need to compute the total income, and this question mainly focuses on the area. Which area, friends? It is set off and carry forward. All right. You need to know the inter-source set off and inter-head set off rules for solving this particular question. Anyways, let's solve this question together, friends. So starting with, normally we will write a format for this: particulars, then amount, and amount. 3 amount columns. Normally for a hardcore set off and carry forward question, this format is normally advisable. Why? Because you will come to know after solving this question. All right. So we will start with, initially we should start with the first point. Loss from speculation business is there. We will start from the salary. All right, being the first head of income, we will start from salary. That is 5,25,000. Whatever we have picked, I am crossing it for a better control. So salary 5,25,000 I am writing. So the question says salary from XYZ Private Limited. It is not using a word computed. So what should be the strategy and what should be the assumption? This 5,25,000 is the amount of salary which I have got. From that I can claim what? Standard deduction. If in the question, if they are using the word computed, salary computed, if they are using that word, then our assumption should be what? Then it is, our assumption should be, it is computed after standard deduction. But here they are only stating salary from XYZ Private Limited. That means that 5,25,000 is the annual salary which you got from XYZ Private Limited, and you should apply what? You should apply standard deduction on that particular amount. So that 5,25,000 is the salary. So salary is 5,25,000. From that I'm deducting standard deduction at 50,000 rupees is the standard deduction. So after deducting this standard deduction, what is the net salary? It is 4,75,000 is the net salary. Alright, now the second head of income is house property. So house property, we have interest on borrowings in respect of self-occupied house property, that is 3,18,000, and income from let out house property is also given in the question, that is 1,20,000. So I will consider income from let out property first. So house property and income from let out property, and that is, what is the income from let out property, friends? It is 1,20,000. And again there is another thing, it says income from let out property. All right, income from let out property 1,20,000. So that simply our assumption is from that is not the rent received from let out property. It says income from let out property. That means what? That simply means it is computed after every adjustment under section 23 and 24. All right, so it is the net taxable income. That's what our assumption is. All right, now if they are saying rent received from let out house property, then obviously you need to consider what? You need to consider standard deduction. But they are only using the word income. They are using the word income from house property. That means it is the net taxable income from house property. It is not an assumption. It is obvious. Okay. Again, moving forward, friends, next is interest on borrowings in respect of self-occupied property. So on self-occupied property, there is another property that is a self-occupied property, and on that there is an interest amount of 3,18,000. Even though the actual interest is 3,18,000, maximum deduction under 24B is 2 lakh being a self-occupied property. So loss from, or I'll do one thing, I'll take, there is a self-occupied property and the net annual value would be 0. Then under section 24B, interest on loan, we will claim 2 lakh as a deduction. Even though the amount is 3,18,000, you can claim only up to 2 lakh, and hence the 2 lakh is the loss from self-occupied property. So loss from self-occupied property would be 2 lakh. I will write each and every loss first, then we will go and we will do the other adjustment. So we can definitely set off these two. And I will write the outcome in the next column. All right, that outcome is 80,000 loss from the head house property, and here it is 4,75,000 income from salary. All right, so let me write these two. Then which is the next head of income? So we have already done with these two, so I'm crossing it. So next is business. In PGBP, profits or gains from business or profession, is the next head. So I'm writing PGBP. So which all are the incomes and losses, starting from loss from speculation 85, then profit from speculation 45. So there is a speciality for speculation business. That means loss from speculation business can be set off only from profit from speculation business. So there is a problem with the loss of speculation business. If there is a loss from speculation business, you can set it off only with profits from speculation business. All right, so I'm writing profits from speculation business first. Profits from speculation business. And what is the profit from speculation business, friends? As per the question, profit from speculation business Y, it is 45,000. 45,000 is the profit. Then there is loss from speculation business, and that is business X, right? So that is loss is 85,000. Can I claim this entire 85 as a deduction? Entire 85 I cannot, because it is profit is only 45, right? So there is a balance amount of speculation loss, and that is again 85,000 minus 45,000, it would be 40,000 is the balance, and it have to be carried forward to the next year. Carry forward to next assessment year. Because why? Because the reason is Speculation business loss can be set off only from speculation business profit, and there is no other speculation business profit in this particular question. That's why we are carry forwarding it to the next year. Tata, bye bye. See you next year. All right. So what is the next point, friends? So both 85, 45 we have already dealt with. Next is presumptive income from trading and manufacturing business under section 44AD. So it is, we can call it as a normal business income, and you have opted for presumptive scheme, and the presumptive profit is 1 lakh. That's what it means. All right. So presumptive profits, we can write normal business profit by applying 44AD, and the amount of profit is 1 lakh. All right. Can you claim this 40,000 loss from this 1 lakh? Answer is no. Why? Because this is a normal business and the 40,000 is from speculative. That's why we carry forward to the next year. Hope you remember that point. So, is there any other business loss, friends? Is there any other business loss? Then interest on public provident fund is there, long-term capital gain, short-term capital loss, investment in taxes deposit. There is a brought forward loss of business from assessment year 15-16. So from previous year 14-15, there was a brought forward loss. Now the question is, under section 72, if there is a brought forward loss, you can carry forward it to the subsequent 8 years and you can set it off. So this brought forward is actually from which assessment year? 15-16. That means previous year 14-15 is the previous year 14-15. It has been carried forward. So subsequent 8 years you can use. That means subsequent 8 years means from 13-14, 12-13, 11-12, 10, oh sorry friends, it is to forward, right? So from 13-14, 12-13, then 14-15, 15-16, I'm going backwards. We need to count forward. All right. So 13-14 is the first, then 14-15 second, 15-16, 16-17, 17-18, 18-19, 19-20, and 20-21 is the relevant previous year. So let's count it off. 1, 2, 3, 4, 5, 6, 7, 8. Thank God it is the last year. It is the 8th year, so you can carry forward and you can set it off from 2021, no doubt. So from 2021 you can set it off. So the brought forward business loss. And what is the brought forward business loss amount coming, friends? The brought forward business loss amount is 1 lakh. So the brought forward business loss amount coming here is exactly 1 lakh. All right. So that 1 lakh you can entirely set it off. That 1 lakh you can completely set off from this particular year, and there is nothing left. All right. So the entire business profits and loss is completely gone. So friends, one thing you have to be very careful. First of all, you need to do the inter-source adjustment. Then only you are supposed to do inter-head adjustment. All right. So then we have dealt with this 1 lakh also. Now the next head is capital gains head. There is no other thing in relation to profits and gains from business or profession. So next is capital gains. Capital gains. So starting with the capital gains, friends, what is the first point given in capital gains? It is interest on PPF is IFRS. Then long-term capital gain on sale of vacant land. There is a long-term capital gain of 1,25,000. So we will take that long-term capital gain on sale of land, sale of some vacant land, and the amount is 1,25,000. All right. Now, is there any loss from the head capital gains? Yes. There is a short-term capital loss on sale of jewelry. All right. And that is 65,000. So I'm considering that short-term capital loss on sale of jewelry. That is short-term capital loss on jewelry. And it is 65,000. Now the point is, from short-term capital loss, definitely that short-term capital loss can be used to set off long-term capital gain. All right, because short-term capital loss can be set off from long-term capital gain and short-term capital gain. But if it was long-term capital loss, then you can set it off only with long-term capital gains. Here for short-term capital loss, he does not have any preference. He will definitely set off with long-term capital gain as well as short-term capital gain. And hence this 65,000 can be definitely set off with this 1,25,000, and the remaining LTCG. What is the remaining LTCG? 1,25,000 minus 65,000. The remaining long-term capital gain would be 60,000. That is the remaining long-term capital gain, and it is normally taxed under 112. All right. Normally the rate is 20% because it is the balance long-term capital gain on sale of vacant land. So it is normally taxed at 20% flat. Hope you remember the rate of tax under 112. Now, is there anything else? We have dealt with these two. Now, interest on public provident fund. Friends, interest on public provident fund is fully exempted. All right. Interest on public provident fund is fully exempted. So, I'm not considering that particular income. I'll write a note. All right. Under IFOS, interest on public provident fund, and what is the amount? Interest on public provident fund, it was 65,000 rupees. It is exempted, fully exempted, so that 65,000 rupees is fully exempted. You don't need to consider anything for that. So it is a completely exempted income. Now, investment in tax savers deposit. So that is a tax savers deposit in investment scheme deductible under 80C. All right. So that 60,000 is definitely deductible under 80C. And the next item is a donation to charitable trust recognized under 12AA. That is an 80G item. 80G and 80C items remaining. All right. So I'll do one thing. Chapter 6A deduction. Chapter 6A deduction is there. One is 80C and the other one is 80G. First of all, let's compute the gross total income and then we will move forward. So now there are certain in the head possibilities. There is a profit from the head salary, then there is a loss from the head house property, then there is nothing from PGBP left, nothing from PGBP left, then capital gain, there is a gain 60,000. It's a gain. Now friends, this 80,000 house property loss can definitely be set off from both the salary income as well as long-term capital gain income. All right, but if you set off this particular 80,000 from initially from this long-term capital gain of 60,000, what is the advantage? Because as you know, that 60,000 is definitely taxable at the rate 20% flat. All right, if you set off this 80,000 from this particular 60,000, that 80,000 loss from house property, if you set it off from that 60,000 long-term capital gain, then the 20% flat rate income will be zero. Got my point? Instead of that, if you are setting off this 80,000 initially from this 4,75,000 salary income, that 4,75,000 will form part of the slab, normal slab, and the slab rate will be under 5 lakh. It is under 5 lakh and the rate would be anyways 5%. So you tell me which is more beneficial, from 112 taxable long-term capital gain 60,000 or from 4,75,000 salary income, which is more beneficial, this 80,000? Definitely no doubt that 80,000 have to be initially set it off from the long-term capital gain because the rate of tax is at 20% under 112. All right. It is actually not a thumb rule. It is as per this circumstance of this question. If you set off that house property loss initially from long-term capital gain, then assessee is supposed to pay lesser amount of tax. That's why I'm setting off initially from long-term capital gain. So out of that 80, house property loss, 60,000 I am setting it off from long-term capital gain and my long-term capital gain would be nil. Then remaining, what is the remaining, loss? Then house property loss remaining would be 20,000. And that I will set it off from my salary income. And here 80,000 completely set off. All right. And what is the remaining house property, salary head profit? 4,75,000 minus 20,000, it would be 4,55,000 rupees is my income from salary. Then there is nothing left in this house property loss, is nothing there. Then PGPP is also nothing left. And finally, long-term capital gain also nothing left. Then IFO is also nothing is there. So tell me what is my gross total income? Gross total income would be the same, 4,55,000. Only one income, that is 4,55,000 is my gross total income. Now let's move on to the chapter 6A deductions. Hope till now it is clear. Chapter 6A deduction, you have two items. Number one, it is investment in tax savers deposit 60,000. That is an 80C deductible item. Investment in tax savers deposit. And the amount is, what is the amount? Tax savers deposit 60,000. And you can definitely deduct that. And 80G. From 80G, Then ATG, let's see what exactly is the next item, that is ATG, donation to charitable trust. And friends, hope you remember, under ATG there are 4 category of deductions. Category number 1, 100% deduction without ceiling limit. Category number 2, 50% deduction without ceiling limit. Category number 3, 100% deduction subjected to ceiling limit. And category number 4, 50% deduction subjected to ceiling limit. And this donation to charitable trust, which is approved under ATG, will come under the 4th category. 50% deduction and also subjected to what? Ceiling limit. So let's see what exactly is the ceiling limit. Alright, so I will write a working note number 1. And friends, that ceiling limit will be 10% of adjusted total income. Adjusted total income. Now friends, tell me what is adjusted total income? That is, take your gross total income, deduct chapter 6A items except ATG. ATG, we don't know what is the limit, that's what we are going to compute. So from your gross total income, deduct all chapter 6A except ATG. Now deduct if there is any long-term capital gain which is taxable under 112 or 112A. That's what the Act says next. So if there is any long-term capital gain included in the gross total income which is taxable under 112 or 112A, you need to deduct that. And you also need to deduct short-term capital gain which is taxable under section 111A. So in this question, your gross total income is 4,55,000. And there is only one chapter 6A deduction apart from ATG, that is that 60,000 tax savers deposit. Yes or no? The only one item remaining is 60,000 tax savers deposit. So is there any long-term capital gain under 112 or 112A or short-term capital gain under 111A included in the gross total income? No. In the gross total income, there is no 112A or 111A incomes. The only long-term capital gain, we have completely set it off from house property loss. So there is no long-term capital gain income remaining in the gross total income. Alright. So the adjusted total income would be 4,55,000 minus 60,000 and it would be 3,95,000. And 10% of your adjusted total income is the ceiling limit. That is 39,500 is the total ceiling limit. 39,500 is the total ceiling limit which you can claim as a deduction. Now friends, what is the amount which you have contributed? The amount which you have contributed is only 60,000. So 60,000 is the amount which you have contributed. So actual contribution is 60,000. But your ceiling limit is 39,500. Alright. So actual contribution is subjected to 39,500. You have actually contributed 60, but the maximum deduction is 39,500. 50% of 39,500 is your actual deduction which can be claimed under ATG. So 39,500 into 50%, it would be 19,750. Hope you got the point. How to compute again? I'll repeat it again. How to compute ATG? Friends, it is category 4. Category 4 means you are contributing something and that contribution is subjected to ceiling limit. If that contribution, if it is subjected to ceiling limit and the eligible amounts 50% is only the deductible amount under ATG. So the ceiling limit is 10% of adjusted total income. And you know how to compute adjusted total income. We have computed the adjusted total income, that is 39,500. Your actual contribution is 60. Can you claim that entire 60,000's 50%? Answer is no. That 60,000 is subjected to ceiling limit. And what is that ceiling limit? 39,500. So that subjected to ceiling limit 39,500's 50% is the actual deduction under ATG. That's why I've taken 19,750 as a deduction under ATG. Now I will rewrite it here. 19,750 is the deduction. So after claiming this deduction, what is the total income, friends? The total income would be 4,55,000 minus 60,000 minus 19,750 and it would be 3,75,250 is the total income which is taxable in this case. And loss to be carried forward. Loss to be carried forward is speculation loss. Hope you remember, 40,000. It can be subsequently carried forward to next 4 assessment years. So that is the final answer. 3,75,250 is the total income and loss to be carried forward is speculative business loss and it can be carried forward to subsequent 4 assessment years and that is the final answer. Hope it is clear. So next is question number 14. Alright, so question number 14, it says compute the total income and tax liability thereon of Mr. Raghav for assessment year 21-22 from the following details. So by making use of the following details, you are supposed to compute the total income. So Mr. Raghav aged 61 years, so he is a senior citizen. Alright, he is a senior citizen. Then working in a private company from last 10 years. His salary details for the financial year 21-22 is given. Basic salary given, dearness allowance is given, commission given, transport allowance is given. Then medical reimbursement is also given. Mr. Raghav resigned from the services on 30th November 2020. So friends, in 2020-21, how many months he have actually worked? 30th November. So April, May, June, July, August, September, October, November. He worked for 8 months. Alright. So after completing 10 years and 5 months of service, he was paid a gratuity of 25 lakhs on his retirement, and he is not covered under the Payment of Gratuity Act 1972. And he started business of hiring goods vehicle, purchased small 4 goods vehicle on 10th December 2020 and 4 heavy vehicles having gross weight of 20 metric tons each on 1st January 2021. He did not maintain books of accounts for the business of hiring of goods vehicle, and Mr. Shivapal, his very close friend, gifted him 2 lakhs to purchase that vehicles. Alright, so friends, here there is 2 adjustment. Here that is 44AE application will be there. That is presumptive taxation for goods transporters if they are not owning more than 10 goods vehicles in a particular financial year. And it is very evident he have opted for presumptive taxation. Why? Because he is not maintaining books of accounts. So under 44AE, if the assessee is opting for presumptive taxation, then the assessee should not maintain any books of accounts. That's why the question indirectly states that he has no plans to maintain what? Books of accounts. Then again, what is next? And his friend Shivapal also gifted him a sum of 2 lakh. So this gift will be dealt under IFOS. Under 56 subsection 2 clause 10, you are getting a money from your friend as a gift, and the amount of money is more than 50,000, then that entire money received in that particular financial year will be taxable under section 56 subsection 2 clause 10. Anyways, let's move forward. He was holding 30% equity shares in TSP Private Limited, an Indian company, and paid up share capital of the company was on 31st March 2020, 20 lakh divided into 2 lakh shares of 10 each, and which are issued at a premium of 30 each, and company allotted shares to the shareholder on 1st October 2013. So he sold all the shares on 30th April 2020 for 60 per share. And equity shares of TSP Limited are listed on National Stock Exchange. So it will be dealt under 112A. Alright, it will be long-term capital gain have to be computed under 112A. That is what is the hint. So Rajiv has paid STT both at the time of acquisition and time of transfer, and the fair market value as on 1st April 31st January 2018 was 50 per share. So friends, it is computation of 112A, and the share is purchased on or before 31st January 2018. So the cost of acquisition determination is also has a speciality. Anyways, let's move forward. On 12th February 2021, interest on fixed deposit 92,500 credited to his SBI account, and on 30th April 2020, 5,500, and 30th 12 2020, 8,500 credited to interest on savings bank. So friends, there is one more point. On 12th February 2021, there is an interest which is credited to the SBI account. It is in relation to fixed deposit. Alright, if that fixed deposit interest is more than 50,000 rupees, if you have a time deposit with a banking company, and if the interest amount is more than 50,000, then on that interest there will be what? There will be a TDS impact. Hope you remember. Alright, interest other than interest on securities, 194A. So this particular point has a TDS impact. So after deducting TDS, this 92,500 is obviously net. Because if that interest amount is more than 50,000 rupees in a financial year, TDS is required to be deducted under 194A, interest other than interest on securities. And currently due to COVID relief, the rate is 7.5%. So the normal rate is 10%. But due to COVID relief, it has been set at 7.5% till 31st March 2021. So this is credited on 2nd February 2021. So obviously 7.5% TDS would have been deducted from this FD interest. And what about this savings bank interest? A bank, while crediting savings bank interest to a particular assessee, they are not required to deduct any TDS. On savings bank interest, there is no TDS impact. Alright. And again, he deposited 1,10,000 in public provident fund, ATC item. He paid insurance premium 20,000 on life insurance policy, ATC item. And the policy is taken on 1st April 2011. Sum assured is also given. Then he also made a payment of 25,000 towards LIC pension fund, ATCCC item. Then premium of 40,000 paid towards medical policy of self and 20,000 for wife, ATD, medical health insurance item. There was no change in salary of Mr. Raghav for the past 2 years. So the past 2 years there was no change in salary and he does not opt to pay taxes under 115 BAC. So it is as per normal provision as well. Normal provision as well. The cost inflation indexes are also given and you are supposed to find out the what is the requirement of the question. So it is computation of total income and tax liability also as per normal provision. That is what is the requirement. Normal provision. So friends, let's start solving this particular question. We'll start with the first head, that is income from salary. So we will use a format that is particulars, amount, and we'll say analysis and amount format, because it is a conventional total income computation question. For that we will use this particular analysis amount format. Alright, so let's start friends, starting with the first one, basic salary 1,70,000 per month. So very carefully, you have to be very careful, he worked only for 8 months. 8 months in that particular previous year. Alright, so we will take that entire basic salary first. So basic salary 1,70,000 per month into 8 months. So tell me friends, what is the amount coming? 1,70,000 into 8, it would be 13,60,000. 13,60,000 would be the sum. Alright, then what is the next item? Next item, it is DNS allowance, forms part of a retirement benefit. That is 80,000 per month. That's also into 8 months. So DA 80,000 per month into 8 months, that is 6,40,000 will come. 6,40,000 would be the amount. Then what is the next item? Commission 32,000 per month. So commission, it is fixed per month, and commission 32,000 per month into 8 months again, and the sum would be 2,56,000. 2,56,000. What is the next item friends? It is transport allowance, and that is 5,000 per month. Transport allowance, you are not eligible to claim any exemption. So 5,000 per month into 8 months. So it is 40,000 rupees. Then what is the next item friends? Next item is medical reimbursement. Medical reimbursement 40,000. It's only saying medical reimbursement. And for medical reimbursement, there are certain separate treatment. Hope you remember. If it is from a hospital maintained by the employer, or if it is for specified diseases, or if it is from a government hospital or a hospital specified by government, etc., it is fully exempted. But here the question, there is no information in relation to the hospital, whether employed by government or whether it is whether it is a whether it is a government hospital or something. All right. So what we can do, we can take that entire 40,000 as a taxable income. So we will take that entire 45,000 medical allowance. Definitely it would be taxable. For 40,000 it is fully given. All right. So entire 40,000 is given. So moving on to the next adjustment, that is Mr. Raghav resigned from the services on 30th November 2020 after completing 10 years and 5 months of service. He was paid a gratuity of 25 lakhs on his retirement. So what is the treatment of gratuity friends? Treatment of gratuity is very simple. When he receives gratuity, it will be taxable and he is eligible for an exemption under section 10(10). Alright, now let's compute the taxable gratuity. So gratuity, and what is the gratuity he received? The amount he received is 25 lakhs. Alright, so under section 10 subsection 10, he is eligible for an exemption, and the exemption shall be least of the following. So it shall be least of following. So let's compute the exemption. Number 1, actual gratuity received, that is 25 lakhs. Number 2, a statutory amount of 20 lakhs. If he is covered under gratuity or if he is not covered under Payment of Gratuity Act, the statutory limit is the same. Earlier it was 10 lakh, now it has been increased to 20 lakh. Statutory figure has been increased to 20 lakh. And what is the third limit? If he is not covered under Payment of Gratuity Act, then it is half month salary into last drawn salary into completed year of service, ignoring ignoring the months of service left. That's what the act says. So half into last drawn salary, and here there is a definition for salary. And what is the definition for salary? Salary means basic salary plus DA if forms part of a retirement benefit plus commission if it is expressed as a fixed percentage of your turnover. So that is the definition applicable for salary here. And let's compute half into what is the last drawn salary. It is 1,70,000, right? So 1,70,000 plus what is the DA, friends? In the question, DA is 80,000, and it clearly states that it forms parts of retirement benefit. And do you have to take commission here? No, we don't have to take commission here. Why? Because commission here, it is not expressed as a fixed percentage of turnover. Here the commission is monthly fixed commission. So we don't have to take that commission for the purpose of computing exemption under 1010. Why? Because the salary definition is basic plus DA forms part of a retirement benefit plus commission if it is expressed only as a fixed percentage of your turnover. And here we don't have to take commission. Into what is the completed year of service? In the question, it is very clear that he has 10 years and 5 months of service left. So you have to always ignore the fraction while computing the exemption under 1010 if the assessee or if the employee is not covered under Payment of Gratuity Act. And here you need to take only that 10 years as completed years of service. So 10 years. So friends, what will be the sum? So let's compute it together. 1,70,000 plus 80,000 divided by half, into 2. Into 10 years it will be 12,50,000, and that is the third limit. So 12,50,000 is the third limit, and whichever is lower. Now friends, you tell me which is the lower figure. 12,50,000 is the lower figure. Alright, so the actual gratuity is 25 lakhs minus exemption 12,50,000, and what will be the taxable gratuity? 25 lakhs minus 12,50,000, it will be always 12,50,000, right? So 12,50,000 is the taxable gratuity received by the assessee. So friends, is there anything else remaining in the salary head? There is nothing. The next is related to PGBP, and thereafter it is capital gains, and finally IFOs. So there is nothing left in the salary head. So we can compute the gross salary. So gross salary here would be, let's compute 13,60,000 plus 6,40,000 plus 2,56,000. This is 56,000 plus 40,000. Plus again another 40,000 plus 12,50,000, and the gross salary would be 35,86,000. So 35,86,000 is the gross salary. From the 35,86,000 gross salary, definitely assessee can claim what? Standard deduction. Standard deduction under section 16 can be definitely claimed. It is 50,000, and there is no other deduction available because entertainment allowance is only for government employees, and the question is actually silent about professional tax payment, hence there is no other deduction. So after deducting this 50,000, what would be the net salary or the net income from the head salary? It is 35 lakhs 36,000 is the net income from the head salary. 35 lakh 36,000 is the net income from salary. Alright, let it be there. Now let's compute business income, because the next paragraph is in relation to business, right? So he started a business of hiring goods vehicle. So the next head I will write PGBP. Alright, now let's compute it, friends. It says he started business of hiring goods vehicle, purchased 4 small goods vehicle on 10th December 2020. So under 44AE, under section 44AE, how to compute presumptive taxation? If it is other than heavy vehicles, and how to determine whether a vehicle is heavy or other than heavy? If the tonnage capacity is more than 12 tons, that means more than 12,000 kilograms, then it will be a heavy vehicle. Otherwise, that means 12,000 kilograms or less will be always other than heavy. And for other than heavy, how to compute presumptive taxation under 44AE? It is rupees 7,500 per month into number of vehicles into number of months of ownership. Number of months of ownership. It is actually computed based on the ownership basis, not on usage basis. Alright, so here he has four other than heavy vehicles, and which is used for how many months? It has been purchased in the 10th December, right? So it is purchased in 10th December. So December, January, February, March. Part of a month shall be treated as 1 month. Even if it is purchased on 31st December, December have to be treated as 1 month itself, because the 44AE Act is very clear. Part month ownership shall be always treated as 1 month ownership. So here what we are doing is rupees 7,500 into 4 vehicles into 4 months, and that would be 7,500 into 4 into 4, it will be 1,20,000 rupees from other than heavy. So the income is 1,20,000 from other than heavy. Now heavy vehicles. Heavy vehicles, let's compute the case of heavy vehicles. And as per the question, how many heavy vehicles there are? How many heavy vehicles? Let's see, friends. It says he has 4 heavy vehicles as well, having a gross tonnage of 20 metric tons. So the tonnage capacity is 20 metric tons, and it is purchased on 1st January. Alright, so it is purchased on 1st January. So heavy vehicles, how to compute? Rupees 1,000 per ton into number of heavy vehicles into number of months of ownership. Here also part of a month should be treated as 1 month itself. And friends, here there are 4 heavy vehicles having 20 metric ton capacity, and it is purchased on 1st January. So it is pretty simple. Rupees 1,000 per ton into 20 metric tons into how many vehicles? 4 heavy vehicles into 3 months. Alright, so the sum would be 1,000 into 20 metric ton into 4 vehicles into 3 months. It would be 2,40,000. So friends, now the business income in total would be 2,40,000 plus 1,20,000, that is 3,60,000 is the total business income taxable here. 3,60,000 is the total business income that would be taxable under 44AE as per the provisions of 44AE. I hope this is clear. Again, moving forward, friends, the next point is in relation to capital gains. So it is capital gains, and he was holding 30% equity shares in TSP Private Limited, an Indian company, and the paid up share capital of the company as on 31st March 2020 was 20 lakh divided into 2 lakh shares of 10 each. So let's have a separate working note for that, friends. So I'll do one separate working note for that. So working note number 1. Working note number 1. I'll read that particular paragraph, and we will rewrite that paragraph into a very simple form of sentence. So it says he was holding 30% in a company. So he has 30% equity shares in a particular company, and that company is TSP Limited. It says TSP Limited or Private Limited or whatever it is. Alright. And the question says TSP Private Limited, P Limited, and it says it is listed. Alright, no problem. In income tax, you don't have to check all the technicalities of that particular thing. If it is say listed, then treat it as always listed. Alright. So Private Limited, an Indian company, paid up share capital of that particular company as on 31st March 2020 was 20 lakh divided into 2 lakh shares. So this particular company has 2 lakh shares. Alright. So 30% of 2 lakh, what is his percentage of holding into 30%? It will be 60,000 shares. So he holds around 60,000 shares in a particular company. 60,000 shares. Alright. Now what it says, and the share capital of the company. And friends, one thing we have missed. We have missed one thing. So in the previous paragraph, that is in relation to that business paragraph, his close friend gifted 2 lakh for the purchase of vehicle. Alright, so that 2 lakh has a bearing on IFOS. So I forgot to add that point. So what we can do, we can straight away open income from other source, IFOS. So under section 56 subsection 2 clause 10, gift from friend which is more than 50,000 is fully taxable, right? And what is that taxable amount? I think it is 2 lakh. So 2 lakh, the question is very clear in relation to that. So that 2 lakh is definitely taxable under IFOS. And there are certain other IFOS items, so I am not computing the total income from IFOS right now. That we will deal it separately. Now let's come back to that capital gains area, that is 60,000 shares are there. Then what it says, the paid up capital, and he did not and the paid up capital of share cap of the company is 20 lakh, 2 lakh shares at 10 each, were issued at premium of 30 rupees per share. So there is the face value is 10 and it was issued at premium. Alright, so what is the cost of acquisition for a single share for that particular assessee? The cost of acquisition of single share would be 40. How it become 40? Because the face value, the question is very clear, 10 rupees and it is issued at premium. So what is the premium? It is 30 rupees. So for acquiring one single share, assessee or the shareholder have to spend 40 rupees. So the 40 rupees is the actual cost of purchase. Alright, that is the first thing that you have to be very careful about. Now, what it says, there are certain few other pointers in that particular paragraph. It says, he sold all the shares on 30th April 2020 for 60 per share. Alright, now it's pretty much clear. He sold the 60,000 shares for what value? For 60 rupee per share value. Alright, so let's compute the full value consideration first. So I'll go back to the capital gain area. So income from capital gains head. Alright, so the full value consideration would be 60,000 shares into 60 rupee per share. That's what the act says. So 60,000 into 60 rupee per share, it would be 36,000 rupees. Now let's compute the cost of acquisition. Cost of acquisition for shares which is purchased before 31st January 2018, there are certain specialities. If it is a listed share, and purchased on or before 31st January 2018, then how to determine cost of acquisition? Hope you remember, either actual purchase cost or lower of fair market value as on 31st January 2018 or full value consideration at the time of sale. So here whichever is lower you have to pick, and the lower figure and the actual purchase cost have to be compared, and whichever is beneficial have to be finalized. This is what the act says. So friends, what is the actual purchase cost in this question? So I'll do one thing, I'll write that actual purchase cost in the question. So actual purchase cost in the question we have already determined 40 rupees. Now lower of fair market value. What is the fair market value as on 31st January 2018? It is 50 rupees per share. So the fair market value is 50 rupees per share. Now what is the full value consideration at the time of sale? Full value consideration at the time of sale is 60 rupees per share. Now 50 and 60 have to be compared and lower have to be selected. So the point is 50 rupees per share. Now you have to compare this 50 rupees per share with the 40 rupees, that is the actual cost, and you have to pick the beneficial one. And what is the beneficial one? Obviously 50 rupees per share would be the beneficial one. Why it has become beneficial? More cost, less profit. So for the assessee, more cost alternative will be the beneficial alternative always. Or we can say you have to compare the actual cost and the lower one, and whichever is higher can be selected, because being a cost of acquisition we have to always go for the higher ones. So 50 rupees per share is the cost of acquisition for that 60,000 shares. So as per the working note, let's finish off this particular adjustment. 60,000 shares are there into 50 rupees per share. Alright, so 60,000 into 50 rupees per share, it would be 30 lakhs would be the cost of acquisition. And friends, you will not get the benefit of indexation. No indexation benefit. Why? No indexation benefit. Why? Because if it is a share which is taxable under 112A, then the assessee is not subjected to, or assessee cannot claim the benefit of what? Indexation. Alright, so long term capital gain taxable under 112A, Forget about indexation. You will not get the benefit of indexation. That's why I haven't computed, or I haven't adjusted, or I haven't effected the portion of indexation. So the gain would be 6 lakhs. 6 lakhs would be the long-term capital gain. It is the long-term capital gain. Now you will ask me one question, sir, it is only over and above 1 lakh is subjected to tax. Yes, but the gain is 6 lakhs. While computing taxes, you can deduct that 1 lakh. Hope you got my point. Alright, if when the examiner is asking about the gain, then you should say that 6 lakhs is the gain. But while computing taxability under 112A, you can deduct 1 lakh and only the remaining 5 lakh will be subjected to 10% rate of tax. Alright, so I've written 6 lakhs as capital gains adjustment and we have finalized it. Now, moving forward with the next paragraph, is there anything else remaining? Yes, obviously yes. So the next item is interest on fixed deposit 92,500 credited to his SBI account. I've already told you this interest has been credited when it is credited to the SBI account of assessee on account of fixed deposit. Bank will normally credit only after deducting TDS. Yes or no? They haven't specified it whether it is gross or net. But when they are saying an amount is credited, that means it will be always net of TDS. If there is TDS applicability, then definitely bank will deduct TDS. So in this question, it's actually a silent killer because they have been specifically given it is gross or net. But it is not an assumption, it is obvious again. So when the bank is crediting a sum, while paying that sum, if they are required to deduct TDS, definitely they will deduct TDS. Otherwise, there will be penalty and prosecution against the bank. So bank will always follow the norms. Alright. So when the amount is more than 50,000, when the interest amount on fixed deposit is more than 50,000, in the case of a non-resident recipient, then bank is definitely supposed to pay or supposed to deduct TDS. Alright. So IFOS, I think we have already written IFOS here, right? So interest on FD, it is net. Net is 92,500. So TDS would have been deducted at 7.5% is the applicable TDS rate. Applicable TDS rate. While computing income, you must always show the gross income. So what you can do? You can compute the gross income by this formula, 92,500 divided by 100 minus 7.5%. So 92,500 divided by 92.5%, it would be 1 lakh would be the gross figure. 1 lakh would be the gross figure. On that 7.5% TDS, it will be 7,500 would have been deducted by the bank. Alright. Now, on savings bank, interest on SB, savings bank interest is also given in the question. And friends, what is the savings bank element on that particular interest? It is 5,500 and 8,500 credit to the interest on saving bank. So 5,500 plus 8,500 we will compute it together. 5,500 plus 8,500 and that would be 5,500 plus 8,500. It is 14,000 is the interest on savings bank. And if there is interest on savings bank and interest on FD, and if the assessee is what? A senior citizen, then he can make use of a deduction under 80 TTB up to maximum 50,000. Hope you remember. 80 TTB. In this question, it is very clear assessee is a senior citizen. Alright. If the assessee is a senior citizen, then and he receives an interest on savings bank or fixed deposit, on both you can claim maximum up to 50,000. For the same assessee cannot take out the benefit of 80 TTA. 80 TTA and 80 TTB together you cannot take. Assessee being a senior citizen is definitely eligible for 80 TTB. If he is opting for 80 TTB, then forget about 80 TTA. So I'll do one thing. I will write 80 TTB deduction 50,000 here itself. 50,000 is the 80 TTB deduction. Assessee being senior citizen. Assessee being senior citizen is eligible for a deduction 50,000 under 80 TTB. Now, is there anything remaining in the question? There is nothing in relation to incomes. All the income adjustments are over. Now it is in relation to investments. Right. So let's do one thing. Let's compute the gross total income now. So gross total income. Gross total income would be. Before that, we will compute the income from IFOS. That is 2 lakh plus 1 lakh plus 14,000 is 2 lakh. It is 3 lakh 14,000, right? 3 lakh 14,000 is the income from other source. So now to the gross total income, we have 3,14,000 plus you have 6 lakhs from long term capital gain, plus you have 3,60,000 from PGVP, and 35 lakhs 36,000 from your salary income as well. So the gross total income would be definitely 48,10,000. So 48,10,000 is your gross total income. From that, now it's all about deductions. 50,000 deduction we have already deducted under 80 TTB. Now what is the next one? He deposited 1,10,000 in public provident fund. If there is a deposit in public provident fund, it is eligible for a 80C deduction. 80C, public provident fund, and the amount is 1,10,000. All right. So 1,10,000 I have written here. Now, is there anything else remaining? Yes. He paid an insurance premium 20,000 on the life policy during the financial year 2021. So there is a life insurance policy. Life insurance policy, there are certain specialities. If the policy is taken on or before 31st say 31st March 2012, then how much you can claim as a deduction? Then up to 20% of sum assured. Policy up to 20% of sum assured is eligible as a deduction. So here in the question, the sum assured is clearly stated. What is the sum assured? Sum assured is 3 lakh. All right. So 3 lakh, and the policy is taken in April 2011. So definitely the policy is before or on 31st March 2012, and the sum assured is 3 lakh also. So 20% on 3 lakh, let's see what is the figure coming. 20% on 3 lakh, up to 60,000 you can claim as a deduction. But the actual is less, right? What is the actual figure here? The actual premium paid by that particular assessee is only 20,000. So he can claim that entire 20,000 as a deduction. So actual amount is 20. So you can claim that entire 20 as a deduction from this particular point. So 20,000 is the life insurance policy deduction. All right. Now, moving forward with the next one, which is the next one. He also made 25,000 towards LIC pension fund. LIC pension fund is an 80CCC item. All right. So we will write it as LIC pension fund under section 80CCC. And what is the contribution? It is 25,000 he has given. 25,000 is his contribution. Now, is there anything remaining? Now it says 40,000 towards premium of Mediclaim policy for self and 20,000 for his wife, and all the payments are made by account paycheck. So 40,000 for self, that is 80D. So 40,000 for self and 20,000 for spouse. That means for family he have actually paid 60,000. So in this question it very clearly states that he is a senior citizen. He is a senior citizen, so the maximum deduction shall be maximum deduction under 80D for insurance premium paid for the family shall be 50,000. So it would be 50,000 here. And friends, one more thing, it's very clear all the payment are made by account paycheck. And what if it is through cash? If it is through cash, you are not eligible to claim deduction, because under 80D it very clearly states that if you are taking a medical insurance premium, then the premium payment should be in any mode other than cash. So here it is made by account paycheck, so definitely fully deductible under 80D. I hope this much is clear. Now there are no other adjustment remaining. Now it's all other things. Let's compute the 80C items first. So 80C total, it would be 1,30,000 within the 1,50,000 limit, no problem. And there is a 25,000 from 80CCC. So including 80C and 80CCC, the total would be 1,55,000. Hope you remember, we have discussed this in the MCQ area. And what was this? Under section 80CCE, 80C plus 80CCC plus 80CCD subsection 1 shall be always less than or equal to 150. Here 80C and 80CCC total, what is the total coming? It is 1,55,000. So it shall be restricted to 1,50,000 only. So this shall be restricted to 1,50,000, and here 80D, the entire 50,000 you can claim it as a deduction. So friends, after deducting all these items, what will be the total income? So let's compute the total income. 48,10,000 minus 50,000, then minus 1,50,000, then minus another 50,000. It would be, the total income would be 45,60,000. 45,60,000 would be the taxable total income. Alright, now we need to compute the tax liability. So friends, the assessee is not opting for 115 BAC. So total income as per the question is 45,60,000. Out of this 45,60,000, 6 lakhs is from gains under 112A, right? So 6 lakhs under taxable under section 112A, and the remaining other income would be 39,60,000 to the slab rates. Now on this you can deduct 1 lakh, because over and above 1 lakh only will be subjected to tax under 112A. So 1 lakh deduction, it would be 5 lakh remaining into 10%. That is, the basic tax would be 50,000. It is the basic tax. And what about other case? It is 39,60,000. So up to here there is another speciality, because here the assessee is a senior citizen, right? So in the question it is very clear assessee is a senior citizen. In the first part of the question itself, they are clearly specifying that assessee is a senior citizen. Alright, so up to 3 lakh is his basic exemption limit. 3 lakh 0%. Then from 3 to 5 lakh it is 5%, that would be 10,000. Then 5 to 10 lakh it is 20%, that would be 1 lakh. Then over and above 10 lakh, what is the income? Over and above 10 lakh it is 29,60,000, right? On the 29,60,000, 30% is the rate of tax. So 29,60,000 into 30%, it would be 8,88,000. 8,88,000 would be that sum. So 8,88,000 plus 1,10,000, it would be the basic tax total, it would be 9,98,000. Alright, so the total basic tax, it would be 9,98,000 plus 50,000, that would be 10,48,000. Then 4% health and education cess. There is no impact of surcharge, because the total income is less than what? 50 lakh rupees. In the case of an individual, if total income is less than 50 lakh, then surcharge will never come. So 4% cess, it would be 41,920 would be the sum. Alright, so by adding these, the final tax liability would be 10,89,920 will be the final tax liability of this particular senior citizen in this case. I hope this much is clear. So friends, question number 15 is the next agenda. Examine and explain the tedious implication in the following cases along with the reasons thereof, assuming that deductees are residents and having a PAN which they have duly furnished to the respective deductors. So we have to assume all the payees are residents and all the payees have successfully given their PAN numbers to the deductors. By that assumption, you need to mention or state on relation to the tedious impact of these transactions. Alright, so let's start with the first case, that is case number 1. Mr. Kunal received a sum of 10,20,000 on 28th February 2021 as a premature withdrawal from Employee Provident Fund scheme before continuous service of 5 years on account of termination of employment due to ill health. Alright, so friends, you have to be very careful. If there is a premature withdrawal, what is the premature withdrawal? That means if you does not have a continuous 5-year service with a particular employer and you are withdrawing what? Your provident fund, employee provident fund with that employer, then there will be a tax liability. It will be normally taxed as if it is an unrecognized provident fund withdrawal. That's what the act says. But there are certain exceptions. If the premature withdrawal is due to ill health of employee, even if there is a premature withdrawal, if it is on account of ill health of employee, then that entire withdrawal will be fully exempted. It is not subjected to tax. Hope you remember that point. Alright, it is there under the salary head itself. So when an amount withdrawal is not subjected to tax. When there is an withdrawal of an amount which is fully exempted in income tax, is there any TDS requirement? The answer is no. Alright, so let's write the TDS implication here. So premature withdrawal from employee provident fund. Here no tax is deductible under 192A because TDS section is under section 192A. Normally TDS is required to be deductible if that employee provident fund withdrawal is subjected to tax in the hands of recipient. But here it is not taxable. No TDS is required to be deducted. Why? Because Mr. Kunal has not completed 5 years of continuous service. It is right. But since termination of employment is on account of his ill health, hence Rule 8 Part A of the 4th schedule is applicable in this case, and that entire sum withdrawn will be fully exempted in the hands of Mr. Kunal, and TDS is not required to be deducted at the time of withdrawal. And that is the implication of TDS in this particular case. I hope it is clear. Moving forward to question number or part number 2. Indian Bank sanctioned and disbursed the loan of 12 crore to B Limited on 31st December 2020, and B Limited paid a sum of 1,20,000 as a service fee to Indian Bank for processing the loan application. So here a service fee has been given by that particular ABC Limited to the banking company. So you tell me, is that particular thing taxable in India? Is there any TDS implication as per the Income Tax Act 1961? So on payment of service fee to bank, you have to be very careful. Even though the service fee is included in the definition of interest, even though the payment made by the company to the bank on account of loan, it is just like a processing fee. Even though it is called as a processing fee, it is just like an interest received by the bank. Alright, under section 2 subsection 28A, it will be treated as an interest itself, but no tax is deductible at source under 194A since the service fee is paid to a banking company. Hope you remember, if you are making any interest other than interest on securities under 194A and the recipient is a banking company, say I have taken a loan, alright, and I am paying interest to bank, do I have to deduct TDS from that interest? No, it is not required because any payment to a banking company is not covered under 194A. Hope you got the point. So 194A is very clear. If the recipient is a banking company, then the payer is not supposed to deduct TDS. He is not required to deduct TDS under 194A. So even though this processing fee or service fee can be called as an interest, but the payee here is an Indian bank and TDS is not required to be deducted. I hope this point is also clear. Again, point number 3. Mr. Agam working in a private company on deputation for 5 months from October 2020 to February 2021 at Mumbai, where he pays a monthly house rent of 32,000 for those 5 months, totaling to 1,60,000. Rent is paid by him on the first day of the relevant month. So the point is here they are asking whether TDS is required to be deducted while making that rent payment. Alright, so the applicable section is 194IB. Hope you remember. Under 194IB, if the monthly rent is more than 50,000, if the rent is paid by an individual and he is not covered under 194I, that is TDS on rent, and the monthly rent is more than 50,000, then he is supposed to deduct a TDS at 5% while making that rent. This is what 194IB is all about. But here the monthly rent is only, what is the monthly rent here? It is only 32,000. So TDS is not required to be deducted by Mr. Agam. Anyways, let's see the answer. On payment of rent by the salaried individual, Mr. Agam, a salaried individual, is not liable to tax TDS at 5% under section 194IB on that 1,60,000 from a rent of 32,000 payable on first day of every month, since the monthly rent does not exceed 50,000. That's what I've told you. Under 194IB, if an individual who is not covered under 194I while making a payment that is called a rent, and the monthly rent, if it is exceeding 50,000 rupees, then only 194IB will be applicable. Here the monthly rent is only 32,000, right? So 194IB provisions are not applicable and hence TDS is not required to be deducted. So the answer to 3 alternatives, no TDS, no TDS, no TDS. I hope this is clear. It is only a theory question. So friends, now let's discuss question number 16, the last question of this particular RTP. Alright. So Mr. Subhash engaged in the business of trading electrical appliances. His turnover for financial year 1920 and 2021 was 12 crore and 9.5 crore respectively. During the previous year, XYZ Limited placed an order for purchase of electrical appliances for 55 lakhs on 1/8/2020. So the relevant previous year is 2020-21. He again placed an order for 35 lakhs on 1/11/2020 and Mr. Subhash delivered both orders within 15 days of receipt of orders. So discuss whether Mr. Subhash is required to collect tax at source on consideration receipt from XYZ Limited. So friends, here you are supposed to give an advice whether TCS is required to be collected on that particular sum or not. So the applicable rate or section is under section 206C1H. This is the applicable section here. So under 206C1H, if a seller, and this is with effect from, this particular provision is with effect from 1st October 2020. So a seller, if his aggregate sale is more than 50 lakhs, then he is supposed to collect TCS at 0.1% on that excess value. This is what the Act says. Alright, and now due to COVID, it has been set at 0.075%. This is due to COVID, the rate has been reduced. And now friends, there is one more point. It says a seller is not required to collect TCS. Not collect TCS even if the sales value is more than 50 lakh if his immediately preceding financial year total turnover is less than 10 crore. So if you are a seller and you are selling goods to a person and the sales value, if it is normally exceeding 50 lakhs, then on that excess 0.1% is the TCS that you have to collect being a seller. But the Act says the seller is not required to collect TCS on the excess amount of 50 lakh if his immediately preceding financial year's total turnover does not exceed 10 crore. Alright, now on this information, let's analyze whether Subhash is required to collect TCS. Alright, so friends, Subhash's turnover relevant previous year is 2021. So immediately preceding financial year will be 1920 and the turnover is 12 crore. So immediately preceding financial year, that is 1920, his turnover is more than 10 crore and hence TCS is required to be collected. And now, what is the total value of sales made by Subhash to the buyer? Initially, the buyer is XYZ Limited. So initially on 1/8/2020, on 1/8/2020, he sold a value which is 55 lakhs. He sold worth 55 lakhs goods to XYZ Limited. And again on 1/11/2020, on 1/11/20, he sold goods worth 35 lakhs to again XYZ Limited. So if you could check, the total is around 55 plus 35, it would be 90 lakh sum. Total in that financial year is 90 lakh. And in the immediately preceding financial year, Subhash being the seller, his total turnover is more than 10 crore. It is around 12 crore. So these are the things. But as you know, under section 206C1H is effect from 1st October 2020 only. So here he is definitely a eligible seller, or he is required to collect TCS in this case. Why? Because his preceding financial year's turnover is more than 10 crore. That is point number 1. And now for this 55 lakh, even though it exceeds 50 lakhs, he is not required to collect TCS. No TCS required. Why? Why? Because it is before 1st October 2020. It is on 1st August 2020. So the effective date is only on 1st October 2020. So for this 55 lakh, TCS is not required to be collected. But for this 35 lakh, definitely TCS is required to be collected. Why? Because the total sales for the entire financial year exceeds 50 lakh. That is around 90 lakh. So for computing that threshold 50 lakh, you need to consider that entire 2021's sales value. And whatever sales after 1st October 2020, which is over and above 50 lakh in that particular financial year, you are supposed to collect TCS. Alright. So for that 35 lakh, assessee is supposed to collect TCS at 0.075%. Now normal rate is 0.1% and now it is 0.075%. This is what the Act says and this is the TDS implication. So friends, let's have a look at the answer. So as per 2061H, TCS is required to be collected at 0.1% and due to COVID it is 0.075%. Alright. On sales consideration exceeding 50 lakhs, then tax is required to be collected at source by the seller being a person whose total turnover from business exceeds 10 crore during financial year immediately preceding the financial year. So the relevant financial year is immediately preceding financial year. If it is more than 10 crore, TCS is required to be collected. Now, here the effective date is only from 1st October 2020. So TCS is not required to be collected on source on sale which has happened before 1st October 2020. Obvious. And here that 55 lakhs sales happened before that 1st October 2020 and hence TCS is not required to be collected. So TCS is required to be collected only on that 35 lakhs at the rate 0.075% and that is what is the final answer. Alright, hope this is clear. So friends, by this I can say the entire RTP or the entire questions including MCQ and descriptive questions we have discussed in detail. Alright, hope you got a clear picture on this particular revision test paper 2021 May attempt. So please don't forget to share this video with your friends because sharing is always caring. So take care friends, see you and bye-bye.